Come sit close for a moment. I want to speak plainly, as one friend to another. I have watched people I care about feel anxious, dazzled, or even ashamed around money, afraid to invest or afraid not to. I know how markets can pull at our hopes, then tug at our fears, so I wrote this to give you a steady hand to hold. Not a secret shortcut to riches, not a magic signal that tells you when to jump in or out, but a sound framework for making decisions and the emotional habits that keep those decisions intact when the world grows noisy. I'm not here to dazzle you with clever tricks or complicated analyses. I will spend comparatively little time teaching you how to dissect a security with a microscope. What matters more for you, the lay investor, is the set of principles you adopt and the attitudes you practice. I will still bring you close to concrete choices by comparing specific securities, often in pairs, to show in the flesh what really matters when deciding among common stocks. Yet much of our time together will travel back through decades of market behavior. To invest intelligently, you must be forearmed with an adequate knowledge of how bonds and stocks have actually conducted themselves under a range of conditions, some of which you too are bound to meet. You know the proverb from Santayana? Those who do not remember the past are condemned to repeat it. Think of it this way. If you were walking a path your family takes every winter, you'd listen to their stories about the thin ice, wouldn't you? We must begin with an old, nearly forgotten distinction: investment versus speculation. This book is not a how to make a million manual. There are no sure and easy paths to riches on Wall Street or anywhere else. Let me show you why by opening a page of financial history. In 1929, John J. Raskob, a prominent figure on Wall Street and in national affairs, wrote, "Everybody ought to be rich." His thesis: save $15 per month, put it into good common stocks, reinvest the dividends, and in 20 years you would hold an $80,000 estate against total contributions of $3,600. The promise seems simple, almost irresistible. Our rough calculation, assuming purchases among the 30 stocks in the Dow Jones Industrial Average, shows that if you had followed that plan from 1929 through 1948, you would have ended with about $8,500. That is far from $80,000. But here is the full picture. That result still works out to better than 8% compounded annually, even though you would have begun with the DJIA 300 and ended with a valuation based on the 1948 close at 177. The lesson? Regular monthly purchases through thick and thin, what we call dollar cost averaging, can produce a solid if unspectacular outcome even when the times seem cruel. Imagine setting aside a small, steady portion of your paycheck every month into a sober fund while you ignore the headlines. It's like contributing to a family savings jar. Rain or shine, you never feel rich overnight. But when a big need arrives, that jar is there. Since this book addresses investors rather than speculators, I must also say, I am not writing for those who try to trade in and out, guided by charts or mechanical signals to buy because prices have risen or sell because they have fallen. That is the exact opposite of sound business sense everywhere else. In half a century of watching markets, I have not known one person who consistently, lastingly made money by following the market in that fashion. I consider such technical approaches fallacious, however popular. If you've ever bought a gadget because it kept going up on social media only to watch it fizzle in your hands, you already know the feeling such strategies deliver. This book has been revised every few years to keep pace with developments without losing the anchor of enduring principle. Since the 1965 edition, a number of changes have confronted investors: an unprecedented advance in the interest rate on high-grade bonds, a fall of about 35% in the price level of leading common stocks, ending in May 1970, the highest percentage decline in roughly 30 years. Countless lower quality issues shrank much further. A persistent inflation of wholesale and consumer prices, gaining momentum even as general business declined in 1970. The rapid development of conglomerate companies, franchise operations, and other novelties in business and finance, including letter stock, stock option warrants, misleading names, use of foreign banks, and others. Bankruptcy of our largest railroad, excessive short and long-term debt at formerly strong companies, and a disturbing problem of solvency among Wall Street houses. The advent of the performance vogue in managing investment funds, including bank-operated trust funds, with disquieting results. We will examine these carefully. Some call for shifts in emphasis since the prior edition, but not a change in bedrock principles. Those do not alter from decade to decade. Their application must adjust as the financial climate shifts, like a sailor who respects the compass even as he trims the sails. If you've ever kept the same core rules for your household budget, but adapted how you shop when prices change, you already understand this balance between principle and practice. When I finished the first draft of this revision in January 1971, the market was recovering from its 1970 low at 632 and pressing toward a 1971 high at 951. Optimism was in the air. By November 1971, as I finished the last draft, the market had slipped again to 797, and uneasiness returned. I did not allow these swings to sway the core policies I'll set before you. They remain essentially what they were when I first wrote this in 1949. In fact, the 19691970 shrinkage should have dispelled a comforting illusion that had gathered for 2 decades, that you could buy leading common stocks at any time and at any price, and not only be assured of profit eventually, but also be rescued quickly from any interim loss by a fresh surge to new highs. Too good to be true, and it was. The market has returned to normal in the sense that both speculators and investors in stocks must be prepared for significant, sometimes protracted declines as well as rises. If you've ever planned a family trip assuming every highway will be clear, then hit a long traffic jam, you know why normal includes slowdowns. The last break was catastrophic across many secondary and third-line stocks, especially in recently floated enterprises. We have seen that before, as in 1962, the new twist. Some investment funds themselves held large commitments in highly speculative, obviously overvalued issues of that sort. The lesson, for beginners and supposed experts alike, is that while enthusiasm is wonderful for art, science, and enterprise, on Wall Street it almost invariably leads to disaster. Think of the friend who insists on doubling down in a card game after a lucky hand or two. It's not a strategy. It's a move with a price tag. Now to a practical question raised by the dramatic rise in interest rates on first-quality bonds. Since late 1967, the investor could obtain more than twice as much income from such bonds as from dividends on representative common stocks. At the beginning of 1972, the return was 7.19%. on highest grade bonds versus 2.76% on industrial stocks. At the end of 1964, figures were 4.40% and 2.92%, respectively. In 1949, the numbers were almost the reverse. Bonds yielded 2.66% and stocks 6.82%. In previous editions, I urged the conservative investor to hold at least 25% in common stocks, and generally favored a 50-50 division. Now we must consider whether those richer bond yields would justify an all-bond policy until the relationship becomes more sensible again, as I expect it will. Naturally, inflation matters in that decision. We will devote a chapter to it. Picture your family choosing between a fixed rate, steady paycheck today, and a smaller share of a business that could grow or shrink tomorrow. The right choice depends on the paycheck size, the business prospects, and the rising cost of groceries. From the start, I've spoken to 2 kinds of investors, the defensive and the enterprising. The defensive or passive investor puts safety first, then freedom from bother. The enterprising or active or aggressive investor is willing to devote time and care to find sound securities more attractive than the average. For decades, that extra skill and effort earned a worthwhile reward. I have some doubt whether today's conditions promise a really substantial extra recompense. Next year may differ. Markets always leave room for surprise. So I will still explore enterprising possibilities, both in forms they took before and in ways they may return. If you've ever compared doing your own home repair versus hiring a reliable professional, you know the question: is the extra effort likely to pay off after tools, time, and mistakes? A prevalent creed says, pick the industries likeliest to grow, then the most promising companies in them. It sounds so reasonable that it feels like common sense. Back when computers rose, a smart investor would have chosen that industry and international business machines in particular, and likewise for several other growth fields. But what seems easy in hindsight isn't in real time. Long ago, I warned about the pitfalls here, using air transport stocks as an example. The sheer volume of air traffic did grow spectacularly. Funds loved the shares. Yet despite surging revenues even outpacing the computer, industry technological problems and overbuilt capacity produced fluctuating, sometimes disastrous profits. In 1970, despite a new high in traffic, airlines as a group lost about $200 million for their shareholders. They also lost money in 1945 and 1961. Their stocks fell more in 1,969, 1,970 than the general market. Even full-time experts at mutual funds were completely wrong about the fairly short-term future of a major non-esoteric industry. On the other hand, while funds owned IBM and profited, its looming price and uncertainty about its growth rate led most to keep that wonderful performer at perhaps 3% of assets, too small to transform overall results. Meanwhile, many of their investments in other computer industry companies were unprofitable. Two morals follow. 1. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. 2. The experts do not have dependable ways of selecting and concentrating on the most promising companies in the most promising industries. I did not follow that approach in my own work as a fund manager, and I cannot offer specific counsel or much encouragement to those who wish to try it. If you've ever stood at a fruit stand where everyone crowds around the same basket, you know the best pickings are usually not at the top where all hands reach. So what shall we accomplish together? My main objective is to guide you away from areas of substantial error and toward policies you can live with calmly. We will spend time on the psychology of investors. Your chief problem and likely your worst enemy is yourself. The fault, dear investor, is not in our stars and not in our stocks, but in ourselves. This is even truer now that conservative investors often must own common stocks and thus, willy-nilly, face the temptations and thrills of the stock market. Through arguments, examples, and plain exhortation, I want to help you establish proper mental and emotional attitudes toward your decisions. Many people with ordinary knowledge but the right temperament have made and kept more money than highly trained experts who lack the emotional guardrails. If you've ever stuck to a simple diet with steady results while a clever friend tried 3 fancy fads and backslid, you've seen temperament beat technique. I also hope to implant the habit of measuring, relating what you pay to what you are being offered. For 99 issues out of 100, at some price they are cheap enough to buy. At another price they are so dear you should sell. Years ago, in a women's magazine, I advised readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of recent years and many similar episodes arose when buyers forgot to ask, how much? In June 1970, how much? Could be answered by the magic figure 9.40%, the yield on new offerings of high-grade public utility bonds. That has since dropped to about 7.3%, which still tempts one to say, why give any other answer? But there are other answers worth weighing. And we must prepare in advance for the possibly quite different conditions of, say, 1973 to 1977. If you've ever signed a lease because the rent looked great, only to discover heating costs later, you understand why price is not the only question, just the first. We will set out a positive program for common stock investment. Some of it suits both defensive and enterprising investors. Some is chiefly for the enterprising. One chief requirement may sound old-fashioned. Limit yourself to issues selling not far above their tangible asset value. Practical and psychological reasons underlie this. There are good growth companies worth several times net assets, but buyers of such shares become too dependent on the market's mood swings. The investor who owns public utility shares at about their net asset value can always see himself as owner of sound, expanding businesses, acquired at a rational price, whatever the stock market might say. The ultimate result of such a sober policy is likely to be better than exciting adventures and glamorous growth. Think of choosing a reliable, fairly priced family car over an expensive sports model whose value tenses and relaxes with fashion. The art of investment has a characteristic that goes underappreciated. A creditable if unspectacular result is within reach for the lay investor with minimal effort and capability. But improving that simple standard takes much application and a touch of wisdom. Try to add just a little cleverness, and you may do worse, not better. Since anyone can match the averages by buying and holding a representative list, you might think it would be simple to beat the averages. Yet a surprising proportion of smart people who try fail. Even most investment funds, staffed by experienced professionals, have not done as well as the market over time. And published predictions from brokerage houses have shown less reliability than the toss of a coin. If you've ever tried to outguess the weather app by squinting at clouds, you know how often just a bit of extra cleverness leads you astray. With that in mind, I will emphasize virtues of a simple portfolio policy: high-grade bonds plus a diversified list of leading common stocks. Any investor can do this with a little expert assistance. The adventure beyond that safe, sound territory is fraught with difficulties, especially of temperament. Before you venture further, be very sure of yourself and of your advisors, especially on the difference between investment and speculation, and between market price and underlying value. A strong-minded approach, firmly based on the margin of safety principle, can yield handsome rewards. But choosing to pursue those rewards rather than the assured fruits of defensive investment should follow much self-examination. If you've ever decided whether to start a demanding side business or to keep the stable job and retire early, you know the weight of that choice. A final retrospective thought. When I walked onto Wall Street in June 1914, no one had an inkling of what the next half-century would bring. 2 months later, a world war would close the New York Stock Exchange. Now, in 1972, we are the richest and most powerful country on earth, yet beset by many problems and more apprehensive than confident of the future. Still, across the last 57 years, a comfort remains. Sound investment principles produce generally sound results, despite vicissitudes and casualties as earth-shaking as they were unforeseen. We must act on the assumption that they will continue to do so. That is the point of a compass. A note before we go on. This book does not address your overall financial policy. It deals only with the portion of your funds you are prepared to place in marketable or redeemable securities, that is, bonds and stocks. We will not discuss savings and time deposits, savings and loan accounts, life insurance, annuities, mortgage, or real estate equity. Also, whenever you see now or similar words, understand that I'm speaking of late 1971 or early 1972. It is like reading a letter dated clearly at the top. The advice belongs to that moment. The principles travel farther. Before we close this opening conversation, let me leave you with 3 small, practical steps that match what we have just covered. First, write down in one simple sentence whether you are a defensive or an enterprising investor, and what that means for your time, your temperament, and your tolerance for market swings. A written identity protects you when moods change. Second, choose a basic allocation between bonds and stocks that you can defend to yourself on a bad day, whether 50 to 50 or within a sensible 25% to 75% band, and know in advance what will trigger a quiet rebalance rather than an impulsive lurch. Third, prepare a short list of questions you will ask before buying anything beginning with how much, and including what is the underlying value? What must go right? What if I'm wrong? Then promise yourself you will not skip them, no matter how thrilling the story sounds. But what about you? When you think of your past decisions with money, do you recognize moments when enthusiasm or fear spoke louder than your own rules? If so, you are in good company, and you have come to the right place to learn a steadier way. Let me speak to you as plainly as I can, friend to friend. Before we talk about any particular stock or bond, I want us to agree on the kind of path we're on. This conversation will set the tone for the rest of the book. I'm going to sketch our policy for the individual, non-professional investor, someone like you who wants to grow money steadily while preserving peace of mind. First, we must untangle two words that people on Wall Street often confuse: investment and speculation. When I say investor, I do not mean anyone who happens to buy or sell a security. I mean something precise. Long ago I wrote, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Keep that in your pocket. We will use it again and again. Over the years, people have stretched the word investor until it covers almost any market behavior. Not long ago, you could read a headline declaring, in effect, that small investors were shorting stocks in gloomy unison. Then later the same publication scolded reckless investors for rushing to buy. That isn't careful language. It's a blur. When someone sells shares he does not own in the hope of buying them back lower, that is speculation, no matter what label a headline uses. I want you to see through that blur and keep our definition intact. This muddle matters because it can lead you to shoulder risks you never meant to take. The disappearance of the old line between investment and speculation is a cause for concern. If the exchanges and the people who work through them do not highlight the difference, they will be blamed when speculative losses hit people who never truly meant to speculate. I want you to be clear-eyed about the risks that come with owning common stocks. Those risks are inseparable from their opportunities, and both must be weighed before you act. You should also know this. In most periods, there is no such thing as a pure stock portfolio entirely free of speculative elements. If you own common stocks at all, you must assume that a speculative factor exists in your holdings. Your job is not to eliminate it entirely, but to keep it small and to be both financially and emotionally prepared for adverse results, whether brief or prolonged. That realism is not pessimism. It is prudence. Now, a word about speculation itself. It is not illegal, not immoral, and for most people not fattening to the pocketbook. Some speculation is necessary and unavoidable. After all, in many stock situations, there are real possibilities of both profit and loss, and someone must assume those risks. There can be intelligent speculation just as there can be intelligent investment. But there are many ways to speculate unintelligently. Chief among them: 1. Speculating while believing you are investing. 2. Making speculation your serious business when you lack the knowledge and skill. And 3. Risking more money than you can afford to lose. Let me be blunt. If you are a non-professional and you use margin borrowing to buy, you are speculating, and your broker ought to tell you so. If you chase a hot new issue because it is the talk of the day, that is speculation or even gambling. If you insist on trying your luck, put aside a small, separate fund for that purpose. Small is better, and never add to it merely because a rising market has given you a run of profits. And please, never mix your speculative doings with your investment program, not in the same account and not in your thinking. It is like keeping your emergency savings separate from the envelope you use for weekend outings. The wall itself is a form of discipline. Now, let's turn to the quiet work. What you should expect if you are a defensive investor, that is, if you put safety and freedom from bother first. I define a defensive investor as someone who wants chiefly to avoid serious mistakes and to be spared from frequent decisions and constant worry. To answer what you can expect, I'll recall what I wrote a few years back, note what changed, and then tell you what, as of early 1972, seems sensible. In earlier guidance, I suggested dividing your money between high-grade bonds and leading common stocks. never letting either portion drop below 25% or rise above 75%. The simplest course, if you prefer it, is to keep an even split 50-50 and rebalance whenever market moves tilt the scale too far. That is not glamour. It is hygiene. It is also a way to make sure that when markets fall, you automatically buy a little more of what has grown cheaper, and when markets rise, you trim a little of what has grown expensive. As the years pass, interest rates on first-quality bonds climb to record levels. By the end of 1971, you could get roughly 8% on good medium-term corporate bonds. On the short end, you might realize about 6% on 5-year U.S. government issues with full repayment at maturity. Meanwhile, the dividend yield on leading stocks, with the Dow around 900, stood under 3.5%. Importantly, the interest and principal on good bonds are better protected and more certain than the dividends and price gains on stocks. In that light, toward the end of 1971, bond investment appeared preferable to stock investment, at least on the narrow measure of current income and certainty. But because nothing in markets is certain, we will not advise a 100% bond position. You may ask, what could make stocks the better choice even then? Inflation might accelerate, even if I view that as a remote possibility, making fixed dollar bonds less attractive. Or American business might grow so profitable without inflation's push that stock values rise greatly. Or we might see another large speculative rise untethered from underlying values. Any of these could leave a bond-only investor dissatisfied. That is why I return to a sensible compromise. Always keep a significant part of your funds in bonds and a significant part in equities, whether by the steady 50-50 route or by varying between 25% and 75% in either, according to your judgment. When returns from stocks and bonds look similar as they did, then your overall result won't change much based on the exact split between them. As I calculated, the combined return might be about 7.8% before taxes, or roughly 5.5% after taxes. That may not dazzle anyone who remembers the heady post-1949 period, but that earlier record owed more to shifting attitudes into growth in underlying earnings and dividends. You cannot count on attitudes to rise fivefold forever. What you can count on is your own discipline. Let me bring this down to the kitchen table. Imagine you and I are setting up 2 jars, one labeled bonds, one labeled stocks. You decide on equal amounts in each. When the stocks jar swells because prices rose, you scoop a little from it into the bonds jar. When the stocks jar shrinks in a downturn, you ladle from bonds back into stocks. You are not trying to be clever. You are keeping your balance while others lose theirs. Now for the enterprising partner, the aggressive investor. By all means, if you can bring time, care, and skill to your work, you may aim to do better than average. But before you try to earn more, make sure you will not end up with less. Wall Street offers many ways to put energy, study, and native ability to work and to still lose money if you aim at the wrong targets. So first be clear about which approaches offer a decent chance of success. Trading in the market. This means buying when prices are rising and selling when they turn down, often choosing the issues that have been behaving better than average. And sometimes even selling short, selling what you do not own, hoping to buy back lower. This is not investing. On theoretical and practical grounds, it fails the definition. It does not, upon thorough analysis, promise safety of principle and an adequate return. It is speculation, pure and simple. If you've ever tried to jump on a moving escalator going the other way, you know how this ends. Short-term selectivity. This approach seeks companies reporting or expected to report higher earnings or benefiting from some near-term favorable development. The trouble is that what Wall Street can know in the short run is often common property. The near future is already in the price. When you buy chiefly on this year's superior results or next year's hopeful forecast, you will likely find that plenty of others are doing the same thing for the same reason, leaving you no edge. Long-term selectivity. Here the focus is on a strong record of growth expected to continue or on promising companies that have yet to flourish, often in glamorous fields like computers, drugs, or electronics. The obstacles are twofold. Human fallibility, you can simply be wrong, and the nature of competition, even if you are right. The market price may already fully reflect what you anticipate. You can be correct about the business and still pay too much for the stock. That is like paying tomorrow's winning price today. So where does this lead the enterprising investor? Not without hope. Undervaluation still exists, and logic and patience can find it. But the methods that sound most exciting riding trends, leaping at near-term beats, or betting on distant glory are the very ones least likely to promise safety and an adequate return when you examine them soberly. That is the standard I set. Thorough analysis, safety of principal, adequate return. Let me pause and make this personal. If you have ever chased a stock because your friends were making money in it, you have already met the inner pull of speculation. If you have ever felt the knot in your stomach after buying on a tip, that knot is your teacher. The cure is not to swear off markets. It is to choose your role and your rules before the drama begins. First, guard the line between investment and speculation. Keep speculation, if you must try it, in a small separate corner where it cannot endanger your investment life. Never let a rising market seduce you into adding to that corner. If anything, take some chips off the table when luck seems to lift you. Second, for a defensive approach, choose a bond-stock split you can live with on bad days as well as good. The straightforward 50-50 plan, or an allocation oscillating calmly between 25% and 75% in either asset, will keep you from being drawn heavier into danger at market peaks and will automatically push you to buy when values improve. Third, if you decide to be enterprising, avoid the traps that most people fall into: trading with the tide, chasing short-term beats, and worshiping growth at any price. Favor what is demonstrably undervalued by careful analysis and let patience be your ally. Write down your identity. I am a defensive investor, or I am an enterprising investor. Underneath, list the behaviors that belong to that identity. For defensive, rebalance, diversify, ignore fads. For enterprising, analyze, demand a margin of safety, diversify. Put this card where you will see it before you trade. Decide your starting allocation between bonds and stocks, for example, 50-50, and pre-commit to how you will rebalance when the mix shifts by a set amount. Treat this like brushing your teeth. Routine, not a referendum on the market's mood. Create a tiny, separate speculation jar. If you must fund it once, never refill because of a winning streak, and promise yourself you will never mix it with your investment account. Labeling is a kind of safety rail. But what about you? When prices swing and voices get loud, do you find yourself drifting from the role you meant to play? Or can you still hear your own rules? Let me pull this chair a little closer and talk to you about a force that sneaks into every household quiet at first, then suddenly loud when it pinches: inflation. You and I feel it most when groceries cost more, rent rises, or the same paycheck buys less. On Wall Street, this same pressure bends judgments, often turning caution into sweeping claims. People see that fixed dollar incomes suffer when the cost of living rise, and that a fixed principal amount does too. They also notice that owners of common stocks at least have a chance to offset the loss of purchasing power if dividends and share prices rise. From those plain truths, some have leapt to a grand conclusion that bonds are inherently undesirable and, therefore, that common stocks are inherently superior. I have even heard of institutions being told to keep 100% in stocks and 0% in bonds. That is a dramatic reversal from earlier days, when trust investments were confined by law to high-grade bonds with a few choice preferreds. You and I must view such claims with a cooler eye. Even the best common stocks cannot be a better purchase than bonds under every condition, no matter how high the stock market stands, or how low the dividend yield is beside the rates available on bonds. Saying otherwise is as absurd as the old belief that any bond is safer than any stock. What we must do here is measure inflation's footprint carefully and decide how far it should guide us. And, as in so many parts of finance, our policy about the future must rest on honest knowledge of the past. Is the serious inflation we have endured since 1965 a new creature? Or have we seen its like before? And if so, what did we learn? Look first at the record. From 1915 onward, 55 years set at 5-year intervals, using 1946 rather than 1945 to avoid the last year of wartime price controls. The largest 5-year jolt of inflation came between 1915 and 1920, when the cost of living nearly doubled. Compare that to the 15% advance between 1965 and 1970. In between, prices fell in 3 stretches and rose in 6, at varying rates, some quite small. On that showing, you should allow for the probability of continuing or recurrent inflation. Can we estimate the likely rate? The table suggests no simple answer. It is a patchwork. Still, we can take a cue from the consistency of the last 2 decades. An average annual rise of 2.5% in the consumer price level, 4.5% for 1965 to 1970, and 5.4% for 1970 alone. These are not prophecies. They are signposts. Now, about the instinct to crowd into stocks as a hedge. I understand it, but it can mislead. It took 25 years for General Electric and for the Dow Jones Industrial Average itself to recover the ground lost in the 1929 to 1932 collapse. Concentrating heavily in common stocks with your reasoning tuned to the expectation of further inflation sets a trap. If another bull market comes, you may misread the big rise as proof that your inflation hypothesis is right, so you keep buying no matter how high the market climbs or how low the dividend return falls. That way lies sorrow. What about the standard alternatives people seize when they mistrust their currency? The first, for most of the world, is to buy and hold gold. That has been against the law for U.S. citizens since 1935, luckily for them. Over the past 35 years, the open market price merely advanced from $35 to $48 per ounce, a rise of only 35%, and the holder received no income-only storage expense. A modest savings bank rate would have done better, despite the general rise in prices over that period. The near failure of gold to guard purchasing power should cast doubt on the ordinary investor's ability to hide from inflation by piling into things. And although various objects, diamonds, master paintings, first editions, rare stamps, and coins have shown striking price advances over the years, their quotations often contain something artificial, precarious, or unreal. I find it hard to call paying $67,500 for a U.S. silver dollar, dated 1804, and not even minted that year, an investment operation. I freely admit this is not my field, and very few readers will find the swimming safe or easy there. What of real estate? Owning property outright has long been considered sound, with a decent measure of inflation protection. Yet real estate values can swing widely. Choice of location and price can go wrong, and salesmanship can be a pitfall. Diversification is hard for the investor of moderate means unless you join with others, which brings hazards not too different from buying newly floated common stocks. This, too, is not my field. My simple counsel is, be sure it is your field before you enter it. So where does that leave you and me? Back with the policy I urged before. Precisely because the future is uncertain, you cannot afford to put all your funds in one basket, neither all in bonds, despite their unprecedentedly high recent yields, nor all in stocks, despite the prospect of continuing inflation. The more you depend on your portfolio and its income, the more necessary it is to guard against the unexpected and disconcerting. It is axiomatic for a conservative investor to minimize risks. And I think strongly that the risks in buying, say, a telephone company bond at yields of nearly 7.5% were much less than those in buying the Dow at 900 or any roughly equivalent stock list. But the possibility of large-scale inflation remains, and you must carry some insurance against it. There is no certainty that a stock component will insure adequately, but it offers more protection than the bond component. I said this in 1965, and I would write the same today. I have no enthusiasm for common stocks at these levels, 892 for the Dow. Yet the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if we regard them as the lesser of two evils, the greater being the risks of an all-bond holding. That is not a riddle. It is a reminder that prudence often comes as a pair of choices, neither glamorous, both necessary. Let me bring this down to your kitchen table. If you depend on your portfolio to help pay the mortgage, keep the lights on, or fund the children's schooling, you must protect against two kinds of harm at once: the harm of market declines that can bruise stock values, and the harm of rising prices that can erode fixed incomes. You do that not by chasing a single perfect asset, but by keeping both bond and stock baskets on your shelf, and by refusing to overfill either one. The bond basket gives you definition and certainty. The stock basket gives you participation in enterprise and some defense against rising costs. Then you let the seasons change, and you keep rebalancing your shelves, not because you can predict the weather, but because you can control your pantry. Write down your baseline. On a single card, state the range you can live with. For example, I will keep between 25% and 75% in common stocks, and the balance in high-grade bonds, rebalancing back to my midpoint when the mix drifts. Routine beats bravado when prices move. Pre-commit to your insurance. Decide what portion of your portfolio you will keep in common stocks specifically as protection against inflation, not because you are euphoric about stocks at current levels, but because you will not run an all-bond risk. Write it down so a bull market does not seduce you and a bear market does not scare you out. Refuse the false hedge. Do not rush into things you do not understand: collectibles, glitter, or schemes promising magic against inflation. If real estate attracts you, make sure you understand the risk, the price, and the lack of easy diversification. If you cannot answer, "Is this truly my field?" then keep your capital where your competence lives. But what about you? When prices rise and neighbors brag about sure hedges, do you feel the tug to abandon your simple policy, or can you hear your own rules above the noise? If your stock portfolio is a small window into that vast, often intimidating place we call the market, then prudence asks you and me to study its weather, not just today's sky. I want you to have a working feel for how prices, earnings, and dividends have moved together and apart over long stretches of time. With that background, you can form sound judgments about whether the market level in front of you looks inviting or dangerous. Conveniently, we have roughly a century of usable figures. Beginning in 1871, they are not perfect. Earlier data are thinner than later, but they are more than enough to guide a thoughtful friend. I'll boil the long record down to 2 tables and a chart. One table lists the lows and highs of 19 bull and bear cycles across the past 100 years. Using 2 benchmarks, a composite index that splices the Cowles Commission's early work onto Standard & Poor's 500 stock composite, and the better-known Dow Jones Industrial Average, created in 1897 and made up of 30 large industrial companies with one telephone giant among them. The chart, courtesy of Standard & Poor's, traces the 425 industrial index from 1900 to 1970. Together they show broad patterns, and those patterns matter. Look first at the shapes that chart reveals. From 1900 to 1924, markets tended to rise and fall in fairly similar cycles 3 to 5 years long, with an average annual advance of about 3%. Then came the new era rush that crested in 1929 and broke into a terrible collapse, followed by uneven swings until 1949. Compare the average level of 1949 with 1924, and the long-run advance across that quarter century is a mere 1.5% per year. No wonder the public felt no enthusiasm for stocks by then. As often happens, that lack of enthusiasm ushered in the next phase, the greatest bull market in our history, from 1949 through the late 1960s. It likely culminated around December 1968 at 118 for S&P's 425 industrials and 108 for the 500 stock composite. Between 1949 and 1968, we saw sizable setbacks, especially in 1956 to 1,957 and 1,961, 1,962, but recoveries were so swift that they read more like recessions within one long bull run than like separate cycles. From a Dow low near 162 in mid-1949 to a high near 995 in early 1966, the gain was more than sixfold in 17 years, an average compound of roughly 11% per year, before counting dividends of, say, 3.5%. The S&P composite climbed even more from about 14 to 96. Returns like those were written up with great fanfare in the early 1960s. And it was only human for Wall Street to bask a bit and to draw too much comfort from the past. The decline from the 1968 peak to the 1970 low was 36%. For the S&P composite, 37% for the Dow, the largest since the 44% drop of 1939 to 1942, and then in the market's dramatic way, a swift recovery followed, carrying S&P's industrials to a fresh high in early 1972. Averaging 1949 and 1970, the annual rate of price advance was about 9% for the S&P composite, or its industrial index, far above any similar span before 1950. But note well, in the last decade of that run, the climb slowed to about 5.25% for the S&P composite and roughly 3% for the Dow, the soaring 60s. In truth, we're off in a march up one high ridge and down the next. Price alone never tells the whole story, so I set price beside earnings and dividends, decade by decade. The 10-year averages smooth the noise and show persistent overall growth. Only 2 decades after the first, 1891 to 1900 and 1931 to 1940, showed declines in earnings and average prices, and no decade after 1900 shows a decline in average dividends. Still, growth rates vary widely. Post-war performance generally beats earlier periods, but the 1960s were less vigorous than the 1950s. You cannot read those tables and forecast the next 10 years to the decimal, but you can find all the encouragement you need for a steady, long-term stock policy. I must add a cloud that hung over 1970, a clear deterioration in corporate earnings power. The rate of profit on invested capital fell to its lowest since the war years. Many companies reported net losses. Financially troubled names multiplied. And for the first time in 3 decades, important bankruptcy proceedings reappear. Those facts help convince me that the Great Boom era might well have ended in 1970. Another sober marker. The Dow closed 1970 at a level lower than 6 years earlier, the first time that had happened since 1944, and hot issue prices fell as much as 90% in the debacle, echoing 1961 to 1962. Enthusiasm had cooled. Doubts had grown. Now, how should we judge the early 1972 level? In past editions, I have always tried to answer whether the market then at hand was too high for conservative buying. I can defend those views even now, yet I doubt they were as useful to readers as my plainer counsel. Keep a consistent, controlled stock policy. Resist the urge to beat the market or pick the winners. To connect the dots across time, I briefly recapped our earlier judgments. Favorable in 1948 at 180 on the Dow. Cautiously favorable in 1953 at 275. Dangerous in 1959 at 584. And too high in late 1964 around 892. For present purposes, I shift from the 30-stock Dow to the broader S&P 500. I compare market, earnings, dividends, bond yields, and wholesale prices at 5 earlier dates: 1948, 1953, 1958, 1963, and 1968 with the convenient 100 level registered at various times in 1971 and early 1972. By the 3-year average method, the market's price-earnings ratio in late 1971 was lower than at year-end 1963 and 1968, similar to 1958, and much higher than early in the long post-war bull. If you looked only at that PE, you could argue the market was not especially high in January 1972. But bring bond yields into the frame and the picture darkens. The ratio of stock earnings yield, earnings price, to high-grade bond yields had worsened throughout the period. Dividends told an even starker story back in 1948. Stocks yielded about twice bonds. By 1972, bonds yielded twice and more than stocks. Those adverse shifts, in my judgment, more than offset the better PE. So at 800 to 950 on the Dow, early 1972 looked unattractive for a conservative purchase. What about the path ahead? In historical terms, 1971 still looked like an irregular recovery from the 1,969-1,970 setback. In the past, such recoveries often open a new stage in the persistent bull market that began in 1949, and many on Wall Street expected just that in 1971. The usual danger signal of a frantic new issue boom was largely absent, too soon after the public's harsh lesson of 1,968-1,970. So technically, the outlook seemed to favor another substantial rise well beyond 900 on the Dow before any major decline. And yet, I could not leave it there. The way the 1971 market shrugged off the pain of the year before troubled me. Can such heedlessness go unpunished? I believe the investor must brace for difficult times. Maybe a fairly quick reprise of the 1,969-1,970 fall, or perhaps one more bull market fling followed by a more catastrophic collapse. What course to follow? The same as before at a Dow of approximately 900. The conservative investor should not be drawn into heavy, common stock commitments by the apparent recovery or by technical comfort. Keep your disciplined allocation. Let prices lure you only at sound value. And remember that the long record is a teacher of humility, not bravado. Keep a one-page market yardstick. Track, side by side, the market's 3-year average PE, dividend yield, and the yield on high-grade bonds. If bond yields tower over stock yields, treat optimism with caution. Your income choice is telling you something. Anchor to ranges, not guesses. Pre-decide your stock-bond mix for normal, dear, and cheap market conditions. For example, 50/50th, 35/65th, 65/35th, and let measured signals, not headlines, shift you among them. The century-long record argues for policy over prophecy. Read recovery skeptically. After any sharp decline, refuse to assume the old bull is back. Require evidence in valuation, earnings power, and sensible yields before adding risk. Remember how swiftly excitement returns and how often it forgets recent pain. But what about you? When markets rebound and friends talk as if the storm never happened, do you feel that tug to forget the past? Or can you hold the lesson long enough to protect yourself in the next squall? When friends ask me what their portfolio should look like, I always start with them, not the market. Your mix of holdings ought to reflect who you are and what you need. At one end stand institutions once confined mostly to high-grade bonds and a few preferreds. At the other, the seasoned owner-operator who will buy almost anything if the price is right. It has long been said that those who cannot afford risk must accept low return. I see it differently. The return you may seek should depend less on your taste for danger and more on how much intelligent effort you can bring to the task. The minimum return belongs to the passive soul who wants safety and freedom from fuss. The maximum goes to the enterprising owner who applies maximum thought and care. Years ago, I added, and events proved it truer than even I suspected, that in many cases there may be less real risk in paying a bargain price for a promising issue than in buying a conventional long bond yielding about 4.5%. When rates later rose, even first-class long bonds lost much of their quoted value, while bargains bought with care often did not. Let me turn to the basic problem for the defensive investor: how to divide your money between high-grade bonds and high-grade common stocks. My guiding rule has long been, never hold less than 25% or more than 75% in common stocks, with the inverse for bonds. That rule implies a natural middle, an even split 50-50. Tradition says you raise the stock share when a long bear market gives you true bargain prices. You trim it below half when, in your judgment, the market level has become dangerously high. These copybook maxims are easy to recite and hard to practice because they run against our nature. Still, they draw a line you can live by. If you want something even simpler, and I often do for friends who prefer peace over precision use and oversimplify 50-50 formula and rebalance on a small trigger. When stocks climb to, say, 55% of your total, sell 1/11 of them and add to bonds. If they drop to 45%, move 1/11 of your bond fund into equities. It's a clean habit that quietly makes you sell a bit high and buy a bit low. Years ago, Yale ran a somewhat similar plan geared to a 35% normal stock holding. Later, like many endowments, it drifted to roughly 60% in equities, a lesson in how a great market advance can seduce any formula. My 50-50 version aims to protect you from that drift. It's simple, it points the right way, it lets you respond modestly to market moves, and most important, it restrains you from being pulled heavier and heavier into stocks as prices climb to more dangerous heights. Because bond yields in recent years have been much higher than stock yields, a truly conservative nature may favor the low end of the stock range for a time. The cold-blooded weigher of odds might hold only 25% in stocks now and wait until the Dow's dividend yield is, say, 2/3 of the yield on high-grade bonds before restoring the 50-50 balance. Starting from a Dow level around 900 in dividends of $36 on the average unit. That would mean either bond yields falling from about 7.5% to roughly 5.5%, with no change in stock yields, or the Dow falling towards 660 if bond yields do not drop and dividends do not rise. Why hold any stocks at all if bonds pay so much more? Two historic advantages belong to common stocks. Over long spans, they have tended to offer some protection against the erosion of purchasing power, and they have delivered a higher average return thanks both to dividend income and to the long pull of reinvested profits on underlying value. But those benefits disappear if you pay too high a price. In 1929, people paid such prices. It took 25 years for average levels to recover. Since 1957, high stock prices have also erased the old advantage of dividend yield over bond interest. So I have no enthusiasm for stocks in general at a Dow near 900. Even so, the defensive investor cannot afford to be without an appreciable stock component, the lesser of two evils compared with the risks of an all-bond holding. How then should you choose your stocks? Keep it simple. I suggest 4 rules for the defensive investor's common stock list. Diversify adequately but not excessively. Think a minimum of 10 different issues and a maximum of about 30. Favor companies that are large, prominent, and conservatively financed. The adjectives are broad, but their sense is clear. Require a long record of continuous dividend payments. To be concrete, I would set the bar at an unbroken record, beginning at least in 1950 for today's context in this edition. Impose a ceiling on the price you will pay relative to earnings, not more than 25 times the average of the past 7 years, and not more than 20 times the last 12 months. This restriction will exclude nearly all the most fashionable names, especially the growth stocks. That is precisely the point. About growth stocks, the label should mean a company whose per-share earnings have grown much faster than average and are expected to keep doing so. Some authorities say at least a doubling in 10 years, a compounded rate above 7.1%. Attractive? Yes, if the price is not excessive. The trouble sits in the price. In practice, I find a quieter hunting ground suits the defensive investor. Large companies that are relatively unpopular and therefore available at reasonable earnings multiples. It is a sound, if unspectacular, area for the general public. And keep your hands off hot new offerings of any sort. Over time, they are almost certain to disappoint. On maintenance, submit your list for periodic inspection, say annually, to see whether quality can be improved. If you rely on advisors, use only the most reputable. And make your rules plain so they do not smuggle fashion into your plan. If the original list was competently chosen, you should not need frequent changes. A word on steady buying plans. The exchange popularized monthly purchase programs in which you devote the same dollar amount each month to one or more stocks, an instance of dollar cost averaging. Over the predominantly rising experience since 1949, results were bound to be satisfactory, largely because the plan prevents you from concentrating purchases at the worst times. In a careful study of such formulas, covering 23 10-year periods, first ending in 1929, last in 1952, every test showed a profit by the end of the buying span or within 5 years thereafter. The average indicated profit at the end of those 23 periods was 21.5%, exclusive of dividends. No one has yet found another formula usable with so much confidence of ultimate success, whatever happens to security prices. Some object that few people can invest the same amount each year for 20 years. I think that objection has weakened as common stocks become a staple of sound saving. Small monthly sums, kept up for 20 years or more, can become important. Finally, personal situations call for personal balance. A widow left $200,000 to support herself and her children must blend income needs with the need for safety. An even division between United States bonds and first-grade common stocks fits our general prescription. The stock share might reach 75% for someone fully prepared for that step and almost certain not to be buying at too high a level assuredly. Not the case in early 1972. A doctor in mid-career with $100,000 saved and $10,000 a year to add, or a young earner saving $1,000 a year will set different rhythms, but the same principles hold. Pick your default, 50 to 50 stocks and bonds with a small rebalance trigger. Write it down. When stocks reach 55%, I sell 1/11th. When they fall to 45%, I buy 1/11th. Then follow it like brushing your teeth. Set a yield signal. Promise yourself you will favor the low 25% stock stance until the Dow's dividend yield is roughly 2/3 of the high-grade bond yield. Then restore 50 to 50. Keep the arithmetic handy. Dow near 900 with $36 dividends. Bonds approximately 7.5% implies either bond yields near 5.5% or the Dow closer to approximately 660 if dividends and bond yields don't change. Enforce the 4 rules on every stock you own or consider. Diversify 10 to 30 names, large and conservatively financed, long continuous dividends, and price caps of 25 7-year average earnings and 20 last year earnings. If a candidate fails, let it go. But what about you? When markets rise and friends praise the latest darlings, can you feel the tug to relax your rules, or can you keep your simple, steady policy intact? I want to speak to you simply as if we were on a quiet walk after a long day. Years ago, when the talk of stocks felt loud and triumphant, I kept remembering how quickly that confidence can melt. I'd seen it before. After 1929, it took 25 years for the average to climb back to where it had been. That is a lifetime of waiting if you bought at the wrong moment. So when I tell you what I believe about common stocks for a defensive investor, I'm not lecturing from a mountaintop. I'm confiding. I've known both the comfort of caution and the sting of markets that do not bend to anyone's wish. And I want you to have a plan that stands up to both. Let's start with why common stocks belong in your life at all. In our first edition, back in 1949, I had to make a long case that stocks deserved a place in every serious investment plan. People saw them as inherently unsafe, and after a decline from the post-war highs, many lost confidence just when prices were becoming reasonable. 2 decades later, the opposite mood took over. Soaring prices made stocks look safe at record levels, even when those levels carried new risks. The point one argued then, and still argue now, rests on 2 pillars. First, stocks have historically offered a measure of protection against the slow theft of inflation, while bonds have not. Second, stocks have produced a higher average return over time, thanks to dividend income and the growth that comes when profits are reinvested. Think of it like a small business you own a piece of. Some cash paid out, some left in to grow the shop. Over the long run, that combination has beaten bonds. But there's a catch that can wipe out the advantage paying too high a price to begin with. If you buy dear, even a good business can be a long and lonesome hold. That's why so many who bought near 1929 waited a quarter century to get back. And by 1957, stock prices have been bid up so high that their dividend yields fell below bond yields, a reversal that lasted for years. So yes, stocks have real merits, but price matters. Always. A practical moment of honesty. I had no enthusiasm for common stocks in general at the 900 level of the Dow in late 1971, yet I still believe that a defensive investor cannot afford to hold only bonds. If you own nothing but bonds, you accept risks of a different kind, loss of purchasing power, and the emotional trap of chasing yield. So even when stocks feel like the lesser of 2 evils, the lesser can still be necessary. Balance is your shield. Here's how a defensive investor should approach the stock portion of the portfolio. Keep it simple, but be strict with yourself. I offer 4 rules. First, diversify but not wildly. Hold enough different companies to spread risk, but not so many that you lose track. A sensible range is a minimum of 10 issues and a maximum of about 30. Picture a small orchard you can actually walk through. If you plant 100 trees, you cannot tend them. Second, choose only companies that are large, prominent, and conservatively financed. I know those words are vague, but their spirit is clear. Don't let your savings depend on fragile firms. I'll add a concrete note shortly about what conservative can mean in financial structure. For now, think of stability you could explain at the dinner table. Third, insist on a long record of uninterrupted dividends. I want evidence that the business has shared cash with owners through thick and thin. A good benchmark is continuous dividend payments beginning at least in 1950. At the time I wrote this, every issue in the Dow had met that standard. This is the business equivalent of a neighbor who has kept a promise for years. Fourth, set an upper limit on the price you are willing to pay relative to earnings. Don't let excitement talk you into overpaying. As a ceiling, use no more than 25 times the average earnings of the past 7 years, and no more than 20 times those of the last 12-month period. These limits will automatically screen out nearly all the darlings of the moment, including most growth stocks. That's intentional. We need a margin of safety at the moment of purchase, and discipline about price is the simplest way to get it. What about those growth stocks you hear so much about? By definition, a growth stock is one that has increased its per-share earnings in the past at well above the rate for common stocks generally, and is expected to keep doing so. Some authorities set the bar clearly. Earnings should at least double in 10 years more than 7.1% compounded annually. That kind of success is attractive, of course. The difficulty is not in the business, but in the price people pay to own it. Popular growth stocks usually sell at high multiples of current earnings, and even higher ones of average past earnings. That injects speculation right into the purchase. And when sentiment shifts or growth stalls, the fall can be brutal. IBM, a paragon among growth issues, lost roughly half its market price in only 6 months in 1961.62, and nearly as much in 1969.70. Texas Instruments rose from 5 to 256 in 6 years without a dividend, as earnings grew from 40 cents to $3.91 per share. Yet 2 years later, earnings had dropped by nearly 50% and the price by 4/5 to 49. The lesson is not never buy growth. It is Do not pay any price for the promise of growth. The average defensive investor cannot count on buying exactly right and selling before the air comes out. That is not prudence. That is hope. If you want a calmer hunting ground, look where the crowd is not. Large companies that are relatively unpopular and thus available at reasonable earnings multipliers often make steadier companions for patient money. You may not get fireworks, but you'll sleep better. A practical habit for the defensive investor is periodic review without fuss and without chasing fads. Once a year, ask a reputable advisor to look over your list for possible quality improvements. Make your desire plain. You want to adhere to the 4 rules above. If your initial list was competently built, you should not need frequent or numerous changes. Be wary of advice that seems eager to replace half your holdings every season. That is not investment. It is entertainment. Another steadying practice is dollar cost averaging, the simple commitment to invest the same dollar amount in common stocks at regular intervals. The New York Stock Exchange's monthly purchase plans popularized this formula, and over a long, mostly rising market since 1949, the results were bound to be satisfactory in part because you avoid concentrating your buys at bad times. More than that, Lucille Tomlinson's careful study tested 23 separate 10-year purchase periods, from one ending in 1929 to one ending in 1952. Every single test showed a profit, either at the end of the buying period or within 5 years after. The average indicated profit at the end of those 23 periods was 21.5%, exclusive of dividends. There were stretches when market value dropped substantially along the way, but the method's resilience held. No one has yet found a formula that can be used with so much confidence of ultimate success, regardless of what happens to prices, as dollar cost averaging. If you can't or won't predict the market's moods, set your schedule and keep it. You may object that real life rarely permits the same amount every year for 20 years. I understand. But common stocks have become a normal, even necessary, companion to a sound savings program. Many families already commit monthly sums to savings bonds or life insurance. A modest, uniform amount sent into a simple stock program can be just as practical. The number may be small. Over 20 years or more, it can become meaningful. Imagine treating that monthly investment like a utility bill you always pay to your future self. Now let's bring this down to personal ground. Different lives demand different emphases, but the core policy doesn't change as much as people think. Consider a widow with $200,000 to support herself and her children. Her problem is hard. Income must cover needs, yet risk must be restrained. A compromise that honors both aims is to divide funds about equally between United States bonds and first-grade common stocks. If she is psychologically prepared, and if she can be nearly certain she is not buying at too high a level, the stock share can be placed as high as 75%. That readiness, however, was not present in early 1972. What she must not do is reach for a little extra income with speculative ventures. It would be better to draw $2,000 per year from principal than to risk half the capital in poorly grounded schemes. Picture the monthly budget, a steady mix of interest and dividends, supplemented prudently by a small, planned draw if needed, beats the thrill of a tip that might disappear. Now consider a successful doctor in mid-career, with $100,000 saved and $10,000 to add each year. He faces fewer pressures but not fewer decisions. If he is not inclined to take a deep interest in investing, no shame in that, then the defensive role suits him well. His portfolio can be divided much like the widow's, with the same personal freedom to set the stock portion, and the same rule for investing each year's savings in similar proportions. The danger for the busy professional is overconfidence without study. Medical skill does not automatically convert to market skill, and spare time is scarce. A straightforward defensive program saves him from confusing confidence with competence. Finally, imagine a young person earning $200 per week and saving $1,000 a year. Part should go automatically into U.S. savings bonds. The rest is too modest to justify an aggressive campaign that demands heavy education and strict temperament. The standard defensive program is the easiest and most logical policy. That said, I know how finance fascinates the young. If he wishes to learn, let him study values and test his judgments with the smallest sums. Youth can survive early losses and harvest early lessons. Just do not waste effort trying to beat the market out of the gate. Build habits first. Brilliant moves can wait. Before we close, I promised a more concrete touch on large, prominent, and conservatively financed. Adjectives can be slippery, so here's a firmer line. An industrial company's finances are not conservative unless the common stock, at book value, represents at least half of the total capitalization, including all bank debt. For a railroad or public utility, at least 30% is a sound threshold. As for size and prominence, think substantial capacity and leading positions in their fields. To add some concreteness, large in present-day terms can mean $50 million in assets or $50 million in business. Prominent might mean ranking in the first quarter or third of the industry by size. Don't turn these into iron laws, but use them to keep yourself out of the weeds. Now gather the threads. The defensive investor's stock policy is about building a sturdy lattice, enough diversification to spread risk. Only enterprises big enough and steady enough to deserve your trust, a long dividend habit, and a strict ceiling on price versus earnings to preserve a margin of safety. Add dollar-cost averaging to remove the emotional strain of timing. Review quietly once a year. And tailor the stock-bond balance to your temperament and circumstances without abandoning the core principles. Do this, and you will have something quietly powerful, a plan you can live with when the days are bright and when they are not. If you want 3 steps to act on right now, here they are. First, write down your maximum purchase price rules and follow them. No more than 25 times 7-year average earnings, and no more than 20 times the last 12 months. Make it a rule you can't break without sleeping badly. Second, set up a monthly or quarterly dollar-cost averaging plan in a simple diversified stock program and automate it. Let the calendar do the lifting. Third, choose or screen for 10 to 30 companies that are large, prominent, conservatively financed, and have paid continuous dividends since at least 1950. Then stick to them and review calmly once a year. Those 3 moves, price discipline, steady buying, and quality selection, will do more for your long-term peace of mind than any clever forecast. But what about you? Does this kind of quiet, rule-based plan feel like a relief? Or does part of you still itch to chase the next story you see in the news? Lean in for a second. I want to tell you something that may surprise you. If you decide to be enterprising, your best friend at the start is a list of things not to do. I mean it. Begin on the same base as a defensive investor. Divide your funds between high-grade bonds and high-grade, common stocks bought at reasonable prices, then only branch out when you have a clear, well-reasoned case for doing so. There's no single perfect pattern for active operations. Your choices will depend as much on your interests and equipment as on your competence. But the most useful rules here are negative ones. What to leave alone, what to avoid, what to treat with extra suspicion. Let's begin with a simple filter. Leave high-grade preferred stocks to corporate buyers. Avoid inferior bonds and preferreds unless you can buy them at true bargain levels, typically at least 30% under par for high-coupon issues, and much more for low-coupon ones. Let someone else buy foreign government bonds no matter how tempting the yield looks. And be wary of all kinds of new issues, convertible bonds, convertibles with warrants, and common stocks boasting excellent earnings only in the recent past. This one paragraph will save you from a world of regret. Think of it like grocery shopping when you're hungry. If you decide before you step into the store that you won't buy the candy by the register, you've already won half the battle. On bonds, your default should look just like the defensive plan. For standard bond holdings, choose between high-grade taxable issues, then yielding about 7.25% and good quality. Tax-free bonds up to 5.30% on longer maturities as of late 1971. The point is not to dazzle yourself with novelty. It is to earn a solid income from issuers strong enough to keep their promises. Imagine you're choosing between the reliable family sedan you know and a flashy prototype. One gets you home every night. That's the one you want for the commute? Now, a plain warning about second-grade bonds and preferred stocks. In late 1971, you could find first-rate corporates at 7.25% or more. If that's available, why reach for lower quality merely to squeeze out an extra sliver of yield? In fact, companies with weaker credit have lately been unable to sell plain, straight bonds to the public. They've had to dangle convertibles or warrants. As a result, most inferior non-convertible bonds you'll see are older issues selling at big discounts. Yes, those discounts can produce gains if two things happen. The company's credit improves and general interest rates decline. But do not forget the flip side. When business turns down or markets get rough, these second-quality issues are the first to sag hard. If you've ever bought a used appliance just because it was cheap and then paid for repairs again and again, you know how a bargain can turn into a burden. You can even find well-entrenched, high-quality obligations with old-style low coupons trade around 50 cents on the dollar, as in 1970. Consider these examples. American Telephone and Telegraph 258s due 1986 sold at 51. Atchison, Topeka, and Santa Fe RR4 South due 1995 sold at 51. McGraw-Hill 378s due 1992 sold at 50.5. Discounts like that can give you both decent income and a chance for appreciation without dropping into genuinely weak credits. It's like picking a sturdy winter coat from last season's rack. Same warmth, lower price. But never buy a bond or preferred that lacks adequate safety merely because the yield looks attractive, especially at or near par. When the next bad business period or just a bad market comes along, these near-par second-quality issues are highly susceptible to severe drops, and interest or dividends may be suspended or endangered. For a concrete picture, recall a group of 10 railroad income bonds that sold at an average high of 102.5 in 1946. By 1947, their average low was 68 1/3 loss in a year. If you've ever stretched your family budget to buy the premium version of something that wasn't built to last, you know how quickly shine can fade. Next, foreign bonds. History here is not a bedtime story. Take the 8% bonds of Czechoslovakia, first offered in the United States in 1922 at 96.5. They climbed to 112 in 1928, slid to 67.75 in 1932, recovered to 106 in 1936, collapsed to 6 in 1939, bounced, astonishingly, to 117 in 1946, fell to 35 in 1948, and sold as low as 8 in 1970. If that roller coaster doesn't make you tighten your seatbelt, nothing will. For years, I've questioned the inherent attractiveness of foreign government bonds to American buyers. Today, I'll add that declining these opportunities may benefit both your country and you. It's the financial equivalent of sending money to a distant cousin you barely know because he promises a great return kind in intent, but unwise in practice. Now we come to new issues, initial sales of bonds, preferreds, or common stocks. Be wary. Subject them to unusually severe tests before you buy. Why so strict? First, new issues come with extra salesmanship, so you need extra sales resistance. Second, most are sold under favorable market conditions. That means favorable for the seller, and therefore less favorable for you. If you've ever walked past a store display that screams limited time only, you know the feeling. The urgency is theirs, not yours. When high-grade bonds and preferreds are sold to institutions, the pricing tends to be sensible, and the harm to buy is limited, perhaps unpleasant later if rates fall, but not disastrous. The picture changes as you move down the quality ladder and toward common stock flotations. Lower grade issues in 1,945.46 and 1,960.61 often went to individual, less experienced buyers, and many did not hold up when judged over enough years. They look safe only if you assume recent earnings will keep marching upward without interruption and assumption that prove costly. Bull markets also breed the mass transformation of private businesses into public companies. We saw it in 1945-46, again beginning in 1960, and then step by step to a tragicomic close between 1967 and 1969. The lesson repeats. Enthusiasm supplies the spotlight, not the safety net. Picture a town fair where every new booth claims to sell the next big thing. By closing time, most of those booths are counting empty cash boxes. The same spirit showed up in the 1961 and 1968 booms, the focus shifting to the shares of tiny, less than secondary companies, and to nearly any company in hot fields, such as electronics, computers, and franchise businesses. When the market turned down, these overvalued names were hit the hardest, some all the way to definite undervaluation later on. Fads burn bright. They also burn out. If your neighbor insists that a new gadget can only go up, ask yourself who benefits more from your excitement, you or the seller. So, what does this negative approach add up to? A posture. As an enterprising investor, you give yourself permission to act only when the case is strong by sober, business-like standards. You do not buy inferior credits at full prices because the coupon winks at you. You do not fall for foreign glamour in bond form. You do not let a new issue drumline march you into a purchase. You start from the sturdy base of high-grade bonds and high-grade stocks at reasonable prices, and then you step beyond with care. If the opportunity is not a bargain by clear measures or does not meet unusually severe tests, you pass. How does this feel? Like telling a dear friend, no, when you know the favor will hurt you both. It is not easy, but it is wise. Write your no-buy list on one card and keep it near your checkbook. No high-grade preferreds, leave to corporate buyers. Number inferior bonds or preferreds unless 30% or more under par for high coupons. No foreign government bonds, and no new issues without unusually severe tests. Read it before you say yes to anything. Standardize your bond core. If you hold bonds, choose only high-grade taxable around 7.25% or good quality tax-free up to 5.30% as of late 1971, and ignore the siren song of lower quality for slightly higher yield. You will sleep better. Adopt a cooling-off rule for anything newly offered. If a bond, preferred, or stock is fresh to market, give yourself extra time and demand extra evidence, especially when market conditions are favorable. If the seller insists you must act now, your answer is already clear. But what about you? When a glossy new offering crosses your desk, or a friend swears the yield on a lower quality issue is too good to pass up, can you feel your pulse quicken, or can you set the paper down and ask the tougher questions? If you and I are going to be enterprising together, let's begin with a promise. We will only act when the case is strong and the odds are fairly stacked. I'm not asking you to become a daredevil. I'm asking you to become deliberate. That means we'll still stand on the same sturdy ground as the defensive investor sound bonds and sound stocks at reasonable prices, and only step beyond it when reason, not mood, invites us. When you're tempted to do more, imagine we're in your kitchen with a ledger on the table. We don't move a dollar unless we can explain it to a sensible friend who has no time for jargon. Even on the bond side, an alert, active mind can find special opportunities. I've pointed to a few that may interest a more vigorous temperament. Tax-free new housing authority bonds effectively guaranteed by the United States government. Taxable but high-yielding new community bonds also guaranteed. And tax-free industrial bonds issued by municipalities but serviced by lease payments from strong corporations. The thread through all three is quality of promise and clarity of payment, an uncommon mix of safety and yield. Now, most of our enterprising effort will live in common stocks, and here 4 activities define the field: buying in low markets and selling in high markets, buying carefully chosen growth stocks, buying bargain issues of various types, and buying into special situations. Timing the market by formula deserves its own treatment. I'll take that up next chapter. And I'll say frankly, the last 20 years have not made it easy for anyone without a trader's special feel. Our work here is different. Business-like selection where arithmetic and prudence can guide us. Before we chase what's fashionable, let's talk about what's plain and powerful. Bargains. I mean, issues that are demonstrably worth a good deal more than the market price. Concretely, I do not call it a true bargain unless our indicated value is at least 50% above the price. You can find such a value in two ways. The first is appraisal. Estimate future earnings fairly and apply a reasonable multiple. If the result dwarfs today's price, and if you trust your method, you may have a bargain. The second is to ask, what would a private owner pay? There you will often weigh asset values more heavily, especially net current assets or working capital. Depressed markets are fertile ground for these. The arithmetic and the experience both say courage is rewarded when prices are low and value is plain. Think of a sturdy shop selling for far less than the cash and inventory on its shelves. Even if business is thin today, the floor beneath you is real. There is one bargain type so concrete you can almost touch it, but common stock selling for less than the company's net working capital alone after deducting all prior obligations. In that case, you pay nothing for the buildings, the machinery, the brand, or any goodwill, only for the current assets net of everything senior. It sounds rare, but it has not been. A 1957 compilation, when the market was by no means low, found about 150 such stocks. Buy one share of each of the 85 names then listed in Standard & Poor's monthly stock guide and hold for 2 years. And the portfolio gained 75% versus 50% for the S&P 425 industrials. None showed a significant loss, 7 were about even, and 78 showed appreciable gains. That is what happens when you insist on arithmetic on your side. Of course, these sub-working capital chances come and go. They were common before 1957, nearly disappeared in the long advance that followed, and then returned in the 1969-1970 decline, renewed proof that markets overshoot both up and down. You will not find them every season, but when they show up, a diversified handful has a way of working out well for the patient owner. Another broad hunting ground for bargains is the realm of secondary companies' businesses that are not leaders in a fairly important industry. After the devastations of 1931-1932, investors learned to prefer industry leaders and to neglect the merely respectable middle ranks. The result, most of the time, is lower prices relative to earnings and assets for these ordinary companies, and sometimes prices so low they slip into the bargain class. That neglect is a mood, not a law. Over a span of 5 to 7 years, several forces work in your favor when you buy a carefully chosen list of secondary companies at bargain prices. Dividend returns are relatively high. Reinvested earnings loom large compared to the low purchase price. Bull markets tend to be generous to low-priced issues. Even in flat periods, quiet price adjustments lift neglected names toward normal levels. And specific business changes, new policies, new conditions, new management can repair yesterday's disappointments. In recent years, acquisitions have added a sixth force, larger companies paying relatively generous terms to fold smaller firms into their diversification plans. Underpricing meets a buyer with reasons to pay up. You may ask, if secondary issues are chronically undervalued, won't I always be stuck where I started? Not if you select sanely and let time pass. The math of higher dividends and meaningful reinvestment, plus the market's own habit of re-rating neglected securities, tends to do quiet work for you, especially when your starting price reflects public indifference rather than permanent impairment. Think of a capable colleague who's been overlooked for years. Once results keep piling up, recognition tends to catch up too. What about simple, low multiple methods, say, buying the low price earnings names among the leading stocks? I have long liked the spirit behind such approaches. Value has a way of rewarding patience. But value is not a single test. When we applied a DJIA low multiplier method to purchases at the end of 1968 and looked again in mid-1971, that particular snapshot proved disappointing. A sharp loss for the low multiplier group and a good profit for the high multiplier selections. One poor instance does not overturn 30-odd favorable experiments, but it reminds the enterprising investor to pair low multiples with other quantitative and qualitative requirements, not worship the ratio alone. Beyond bargains and neglected secondary stands a more specialized craft, special situations or workouts. For many years, investors who knew their way around mergers, reorganizations, and other corporate events could earn attractive rates of return almost regardless of the general market. Typical examples included buying bonds of railroads in bankruptcy when you knew the reorganization would leave them worth much more, or profiting from the breakup of public utility holding companies under the 1935 Act. Why do such chances exist? Securities entangled in legal or structural complexity are systematically underloved. Never buy into a lawsuit, says the old motto, and public prejudice holds prices down to unduly low levels. The catch is that this is a technical branch of investment. It calls for unusual temperament and equipment, and in recent years has become riskier and less profitable. It will surely be fruitful again in some cycles. But only a small fraction of enterprising investors should venture there, and never without treating the work like a business. These positive avenues, true bargains, sub-working capital issues, sound secondaries. And for the few, special situations share one habit. Each demands that you buy what is unpopular for reasons that are temporary or superficial and be paid later when opinion normalizes. The discipline is emotional as much as analytical. It asks you to be bored when the crowd is excited and steady when the crowd is bored. Let me end with the broader truth that ties our policy together. You must choose your role: defensive, passive, or aggressive, enterprising. The aggressive role requires enough knowledge of security values to treat your operations as a business enterprise. There is no sound ground for half a businessman, no reliable middle way that promises half the business return. Most security owners should elect a defensive path and be content with its excellent results. The few who go further should do so only when training and judgment are up to business standards, measuring every operation by established business sense. Write one sentence that defines a true bargain for you and tape it to your desk. I will only call it a bargain if my indicated value is at least 50% above price. I will prefer cases where net working capital minus all prior claims alone exceeds the share price. Then, if you cannot show that arithmetic to a friend, you do not buy. Build a small watch list of neglected secondaries. Screen for companies outside the industry first rank that sell at low multiples of earnings or assets, pay sensible dividends, and carry decent records. Let the 5 to 7 year forces work dividends, reinvestment, re-rating, and, when it comes, the next generous bull. If you ever consider special situations, start with humility. Keep them a small, separate effort. Study the event and the documents like a lawyer would. And remember that public prejudice, never buy into a lawsuit, can create price, but only preparation creates profit. If you cannot treat it like a business, do not touch it. But what about you? When you picture buying what others won't touch, because the math, not the mood, is on your side, does that feel steady, or does it make your pulse race? I want to talk to you about the one thing that seems to unsettle even careful people: the market's moods. Prices will rise and fall. Sometimes they will soar. Sometimes they will sink. If you decide to invest, you must accept that swing as part of the weather. Your real task is to decide how to behave while the wind changes. Think of how you deal with a rainy week. You still go to work. You still make dinner. You still put the kids to bed. You don't rip the roof off the house because clouds rolled in. In investing, the same calm habits matter even more. First, a warning I want you to hear as if I were taking your hand. If you feel the urge to speculate, do it with your eyes open with only a little money. And never mix it with your serious holdings. Keep it separate in both your mind and your account. This is the only way to keep a passing impulse from becoming a permanent problem. It's like keeping dessert out of the pantry you use for groceries. One can't spoil the other. Now, how do we try to benefit from market levels without becoming their servants? There are two paths people take. One is timing, buying or holding when you believe the market is turning up, and selling or standing aside when you fear a decline. The other is pricing, buying when quotations fall below fair value and selling when they rise above it. The first turns you toward prediction. The second turns you toward appraisal. I believe you can earn satisfactory results from pricing, but if you emphasize timing in the forecasting sense, you will drift into speculation and very likely end with a speculator's results. It's the difference between guessing the next hour's weather and knowing the climate you live in. And before we go further, please write this short motto somewhere you'll see it. Never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. When you act right after a jump or a fall, you are letting the market's last shout speak for your future. In everyday life, that's like sending a text you'll regret. Because you felt a sudden sting, you would rather cool off and write from your values, not your moods. You should expect the prices of sound stocks to fluctuate, and you should treat quotations as a convenience useful when they serve you, ignorable when they do not. Don't buy merely because a price has gone up. Don't sell merely because it has gone down. Use the market. Don't let it use you. If you picture it as a store that sometimes mislabels the merchandise, you will feel less pressure to rush with the crowd. What should you brace yourself for? A reality most people learn the hard way, across a few years. Many of your holdings will advance by 50% or more from their lows and will also decline by about 1/3 or more from their highs. This is normal, not a sign you failed. When a friend gets a promotion and later faces a tough quarter, you do not declare their career broken. You accept that life moves. Apply the same patience to your portfolio. Because those swings stir our feelings, I'm sympathetic to investors who want a structure that keeps hands busy and minds steady. Simple formula plans once promised to sell stocks automatically as prices rose and to buy as prices fell. They looked sensible and even back-tested well until popularity ruined them. In the 1950s, many who relied on these plans found themselves largely out of the market just as prices kept climbing, with little chance to rebuild positions. It's the old story. Any method easy to copy and follow will be copied until it stops working. Still, there is value in a mechanical habit for one reason deeper than arithmetic: human nature. A simple rule for shifting between bonds and stocks gives you something disciplined to do, especially when the market rises and your energy wants an outlet. As prices advance, you shave a little from stocks and add to bonds. As prices decline, you reverse it. This lets you act in ways opposite the crowd, quietly selling into excitement and buying into discouragement without making heroics of it. In the rest of life, you probably already do this. You add a bit to savings when your paycheck grows and draw from savings when it shrinks, without changing who you are. Let's make this even more concrete by recalling what a conservative portfolio lived through not long ago. From an average level near 890 in the mid-1960s, the Dow Jones Industrial Average reached 995, and about that again in 1968, fell to 631 in 1970, then almost fully recovered to 940 in early 1971. That rhythm up, down, up mirrors what a careful owner of large, conservatively financed companies experience. Secondary issues generally swung more widely, though that did not mean they would do worse over longer spans. The point is not to fear the motion, it's to be prepared for it. I want to tell you a parable that has guided me for years. Imagine you own a small interest in a private business for which you paid $1,000. One of your partners, Mr. Market, stops by every day. He quotes you a price at which he will buy your stake or sell you more. Sometimes his figure seems sensible. Often, his enthusiasm or fear runs away with him. If you are prudent, you will act only when his price is to your advantage, sell when it is ridiculously high. Buy when it is foolishly low and ignore him the rest of the time while you study the company's reports. In the stock market, you have the same privilege. A quotation is an option, not a command. Use it to buy wisely when prices fall sharply and to sell wisely when they have advanced a great deal. At other times, focus on your dividends and your company's results. In daily life, you already do this when you refuse to buy a good jacket at a silly markup, then happily pick it up when it's fairly priced. The presence of a quoted market gives you choices that a private owner doesn't have, but it does not force a price upon you. You may choose to take your idea of value from the business itself rather than from yesterday's tape. That is how owners think. And owners must also recognize, over the longer run, good managements produce good average market prices and bad managements produce bad ones. It's fair to judge not by each day's flicker, which may be unrelated to value, but by the long-range trend that reflects stewardship. When you think about your job or your family's well-being, you look at the long arc, not the last moment. Do the same with your holdings. Because we've spoken so much of stocks, remember that bonds have their own swings. A long-term bond safe in its principal and interest can still vary widely in price as interest rates change. Historical tables show how high-grade corporate and tax-free issues, and even such stalwarts as the Atchison, Topeka and Santa Fe General Mortgage 4 South, due 1995, and the Northern Pacific Re, 3 South, due 2047, rose and fell with yields. The reminder is simple. Safe is not the same as still. In everyday terms, your fixed-rate mortgage payment may be steady while the value of that loan on someone else's balance sheet moves with rates. The promise hasn't changed, but the price has. Even as you aim to benefit from rising values over time, and perhaps to make a few well-judged purchases or sales at attractive levels, beware the soft slide into speculation. It is easy to say, don't speculate. It is harder to live it when markets invite you loudly. That is why I'll repeat our first rule. If you must speculate, limit the amount and keep it entirely distinct from your investment program. The small fence you build today prevents the large regret tomorrow. Let me gather the essence in one sentence. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices. Market movements matter to the investor only because they alternately create low levels at which he should buy and high levels at which he should refrain from buying and perhaps sell. That is the heart of a calm policy. It is the difference between letting the crowd write your diary and writing it yourself. Write and post your rule of use. I will treat quotations as a convenience, not a command, buying only when prices are below fair value and never selling merely because they have fallen. Then tape underneath the motto you copied earlier. Never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. Read both before you place any order. Adopt a simple rebalancing habit. When stocks rise enough to push your allocation above your target, trim modestly and add to bonds. When they fall enough to pull you below your target, add to stocks. This gives your energy a safe outlet and keeps you acting opposite the crowd without drama. Name Mr. Market, don't obey him. Decide in advance that you will buy from him when his price is low, sell to him when it is high, and ignore him the rest of the time forming your view of value from your company's reports. That one mental picture can spare you many restless nights. But what about you? When the screen flashes red or green, do you feel you must act, or can you pause long enough to ask whether Mr. Market's price serves you today? Come closer. Friend, this chapter is about what most busy, sensible people end up owning. Funds. If you'd rather not pick individual stocks and bonds, you can still invest intelligently by buying shares in professionally managed portfolios. The question is how to do it without losing your nerve or your shirt. Let me walk you through the landscape first, then we'll talk about how to choose with a clear head. One straightforward path for a defensive investor is to put money into investment company shares. When the shares are redeemable at net asset value on demand, we call them mutual funds or open-end funds. Most of these are constantly selling new shares. When the shares are not redeemable and the outstanding amount stays about the same, you're looking at closed-end funds. In the United States, all the important funds register with the Securities and Exchange Commission and operate under its rules. Think of it as driving on a highway with patrol cars, no guarantee you'll never see a fender bender. But the rules are there to protect the ordinary traveler. By the end of 1970, this was already a very big world. 383 registered funds with $54.6 billion in assets. 356 mutual funds with $50.6 billion and 27 closed-end funds with $4 billion. If those numbers feel abstract, picture this: enough pooled savings to buy hundreds of sizable businesses outright. That's how much trust people were placing in the fund structure. Funds come in many flavors. Balanced funds keep a significant bond component around 1/3, while stock funds concentrate nearly all their money in common stocks. Some specialize by goal, income, price stability, or capital appreciation. Others by what they hold, bond funds and so on, and still others by how they're sold. Load funds tack on a sales charge, often around 9% on minimum purchases, while no-load funds skip that commission and live on management fees instead. Closed-end funds, meanwhile, trade in the market like any stock, so their prices can drift above or below the value of what they own. If you've ever bought a used car at a good discount to book value, you already grasp the appeal and the risk of that last case. There's another twist worth noting from this era. Some funds split themselves into two kinds of shares, one that soaks up all the ordinary income, another that takes the profits on security sales. These dual-purpose funds try to tailor shares to different appetites, the way a bakery might sell the cake and the frosting separately. Faced with so many choices, the thoughtful investor needs better questions, not glossier brochures. Here are the three I suggest. First, is there any reliable way to assure yourself better than average results by choosing the right funds? And what, exactly, should we make of the so-called performance funds? Second, if the answer is no, how do you at least avoid worse than average results? Third, how should you choose among types balance versus all stock, open-end versus closed-end, load versus no load? Keep these on a card. They'll steady your hand when a salesman talks fast. Let me start where temptation is strongest: performance. In recent years, a code arose in fund management. Some managers aim to beat the market by a wide margin, not once or twice, but as a matter of identity. A few did it for a while. Their returns drew headlines and a flood of new money. But here's the rub. When you're handling really sizable funds, the chase for extra return almost invariably means extra risk. And risks do not stay hidden forever. They come home. If you've ever watched someone drive too fast because they made all the lights last week, you know how this story ends. The performance fashion had familiar warning signs to those of us old enough to remember earlier manias. Many of the stars were still young and had lived their professional lives inside an almost continuous bull market from 1948 to 1968. Success in a fair wind can masquerade as skill. More troubling, a sound investment was too often defined as whatever was likely to go up in the next few months. That led to big bets on newer ventures at prices out of all relation to their assets or their recorded earnings, bets justified only by naive hope mixed with a shrewd sense for exploiting speculative enthusiasm. If you've ever paid a premium for a brand new gadget because everyone else did, only to find the battery dies fast, you felt the same tug. I won't name people, but I will name one fund because its story is public and instructive. Manhattan Fund, founded at the end of 1965. It sold 27 million shares around $9.25 to $10 and began with $247 million of capital. It focused on capital gains, often in issues with high earnings multiples, little or no dividends, and spectacular price swings. In 1967, it posted a 38.6% gain against 11% for the S&P Composite. Then the air went out. The case is not about one manager's virtue or vice. It's about what happens when outperformance is chased with thin safety margins and a crowd is cheering. From here, draw a sober lesson. Smaller size can help a fund stay nimble. Indeed, among the group we studied, several smaller funds outpaced the index across their full period, and the average size was only about $60 million. But the broader experience still says this: large funds, managed soundly, can at best do only slightly better than average over the years, and unsoundly managed funds can first delight, then shock. Yes, there have been exceptions that beat the market for a decade or more, but they were rare, usually specialized, self-restricted in capital, and not hawked to the general public. Don't build a plan on exceptions. Build it on what usually happens. So, what can you do to avoid worse than average results? First, mind the price you pay to get in. Open-end funds are typically sold at a fixed premium about 9% above net asset value to cover commissions and distribution costs, while most closed-end funds can be bought in the market at prices below their net asset value. This gap has little to do with underlying investment results. It's mostly about how shares are sold. If you must buy funds, one clear rule emerges. Prefer a group of closed-end funds when you can get them at, say, a 10% to 15% discount to the value of their holdings, instead of paying a 9% sales premium to enter an open-end fund. If the future dividends and asset changes turn out roughly the same, you've simply obtained more investment for each dollar laid out. That's arithmetic, not prophecy. Next, consider whether you should let a fund do your bond investing for you. When we examined balanced funds, we found bond stakes ranging from about 1/4 to a bit over 1/2 of assets, averaging near 40%. The average income return for these funds in 1970 was about 3.9% on asset value, roughly 3.6% on the offering price. For most investors, it would be more logical to buy their bond holdings directly U.S. savings bonds, A-rated or better corporates, or tax-free bonds, rather than pay fund overhead to own the same thing. It's like hiring a caterer to serve you food you already have in your pantry. Let me step back and wrap this into a plain policy you can live with. If you are drawn to funds, and there is nothing dishonorable about that, aim to keep your advantages simple and sure. Favor situations where the structure itself gives you a head start. For example, a closed-end fund at a decent discount, where costs are not stacked against you and where the manager's promises are modest and grounded. Be skeptical of any fund whose main selling point is a recent streak of wins. Ask yourself, would I be as eager to own this if I hadn't seen last year's chart? We should also be honest about what funds can and cannot do. A diversified, sensibly run fund can offer you convenient, professional oversight and broad exposure. It cannot repeal the realities of markets or the arithmetic of expenses. It cannot, as a group, deliver outperformance to everyone who buys them any more than all students can be above average. If you set your expectations with humility, funds can serve you well. If your heart tugs toward the excitement of performance, pause and remember how the story turned with the last batch of stars. Many rose fast on a fair wind and sank when weather changed. A steady sailor keeps an eye on the compass, not the spray. In practical terms, that means preferring funds that do ordinary things with care diversification, patience, defensible prices over funds that promise extraordinary gains for ordinary risks. To help you act calmly when tempted, keep the 3 questions near your desk. When the chatter gets loud, read them aloud. If you cannot answer the first, can I assure better than average by picking right? With something stronger than maybe, move to the second. How do I avoid worse than average? Often the right answer is as unglamorous as buying what gives you more value per dollar, like closed ends at discounts and refusing to pay avoidable tolls. Then answer the third by fit: balance versus all stock, open end versus closed end, load versus no load. Choose the mix that matches your temperament and your need for income or growth, but never forget the arithmetic underneath. Write a 1-page fund policy. At the top, I will not buy a performance story. I will prefer closed-end funds at a 10% to 15%. Discount to net asset value over open-end funds that cost a 9% premium to enter. Under that, note that for any bond exposure, you'll buy bonds directly unless you have a specific reason not to. Tape this where you will see it before you sign anything. Screen by cost before performance. If a fund structure or sales method imposes a toll at the start or its ongoing expenses are needlessly high, walk away. Your future return cannot outrun simple arithmetic on fees and loads. When in doubt, remember that paying less to own the same assets is the only free lunch in this field. Treat hot streaks as red flags. If a fund is being sold on last year's chart, demand to know the risks taken to get there, the size of the asset base today, and whether the approach would have worked in the last down cycle. If you cannot get a calm, specific answer, or if you sense up next month, thinking, thank them for their time, and keep your checkbook shut. But what about you? When you see a fund that dazzled last year, do you feel your pulse quicken, or can you step back and ask whether the price, the cost, and the structure actually stack the odds in your favor? Let me pull the curtain back and speak to you the way I would to a dear friend at my kitchen table. Investing is one of the few places in business where almost everyone leans on someone else's advice. Most of us are amateurs. Naturally, we look for a steady hand. But there's a quirk in this. When you ask for investment advice, you are, in effect, asking someone to tell you how to make money. In ordinary business, no consultant promises that your own judgment and discipline decide your profit. It is no different here. A good advisor's job is not to conjure riches, but to protect you from avoidable mistakes and to help you earn the normal results your money deserves. Trouble begins the moment you, or the advisor, reach for more than that. Where do people seek guidance? Almost anywhere, a knowledgeable relative or friend, the local banker, a brokerage or investment banking house, a financial service or periodical, and at the professional end, an investment counselor. That grab bag tells you something. There is still no single settled path in investors' minds. So you and I must build one on common sense. If you are defensive by nature, seeking safety first and freedom from bother soon, you cannot and need not pass expert judgment on every recommendation. What you can do and must do is be explicit about what you want to own. High-grade bonds and the common stocks of leading companies, bought at price levels that are not high in the light of experience and analysis. Any reputable stock exchange house can prepare such a list and tell you whether current prices are reasonably conservative by past standards. This is not flashy. It is sturdy. If you choose the enterprising path, work in active partnership with your advisors. Ask for full explanations, pass your own judgment on each suggestion, and let your operations match the growth of your knowledge and experience. Only in rare cases, when an advisor's integrity and competence are tested and proven, should you act without understanding and approving the decision. Your money deserves your mind. Now, about Wall Street itself. Many brokerage houses and their people are honorable and able. Yet the industry's history is steeped in speculation, and speculation is where most customers sooner or later lose. Firms that are truly professional refuse to induce anyone to speculate. They execute orders, supply information and analysis, and give opinions on investment merit without pretending to guarantee profits. Still, the ordinary house lives by commissions and tends to give customers what they want, which often means short-term ideas. If you want to avoid that influence, you must say so plainly and show, by word and deed, that you are not shopping for tips. The right broker will respect that and cooperate with it. 2 roles inside the brokerage deserve a clear picture. The customer's broker or account executive is the registered representative who handles your orders. He is usually a person of good character and knowledge, operating under a code of conduct, but the commission engine around him can tilt the talk toward trading. The financial analyst, by contrast, works up detailed studies, builds comparisons across companies, and offers expert views of safety and value. Use both wisely. Be explicit with the broker about your investing stance, and judge the analyst's work by its reasoning, not by its excitement. There is another subtler relationship to understand: the investment banker as advisor and as salesman. Institutions buying bond issues from underwriters are shrewd, their scrutiny is skeptical, and the transactions are businesslike. But the individual buyer dealing with underwriting houses, especially in common stock, flotations, is easily swayed by the sales story and the itch for a quick profit. Your protection then lies less in your own critical faculty than in the ethics of the seller. And it is dangerous to trust a seller's judgment as if it were your own. The record of 1,961,961 and 1,968,1,969 outpourings of low-quality new issues at high prices should have cured that trust. So, pay attention to reputable houses, but bring independent judgment, yours or another qualified advisor's, to every offering. On practical safeguards. For years I have urged readers to confine dealings, if possible, to members of the New York Stock Exchange, and until the brokerage house troubles of the early 1970s. Fully clear, to have deliveries and payments go through your bank, it is an extra layer of prudence. Better safe than sorry. Not all advice comes from Wall Street. In many towns, it is a good old custom to consult the local banker. A commercial banker may not be a deep expert in security values, but he is experienced and conservative, very useful to the unskilled investor who needs a steadying hand to stay on the straight, unexciting path. The more aggressive investor, hunting for bargains, will usually find the banker's viewpoint too cautious for his aims. As for relatives and friends, much bad advice is given free. It can be as hard to select a good lay advisor as it is to select good securities unaided. At the professional end stand investment counsel firms and the trust and advisory departments of large banks. The best of them are modest in promise and careful in practice. They place clients' funds chiefly in standard interest and dividend-paying securities. They do not bet heavily on market swings. They aim to conserve principal and produce a conservative income. Beyond that, they try to add value, but their greatest service is often shielding clients from costly mistakes. That is as much as a defensive investor has the right to expect from any counselor serving the public. Between the newspaper and the personal advisor sit the financial services that send bulletins on business conditions, market behavior, and individual issues, often at far lower cost than tailored counsel. Some, like Babson's or Standard & Poor's, straddle both worlds. Treat them as tools, not oracles. Their usefulness depends on how clearly you translate general guidance into your own rules. Now, a word about expectations. Most security buyers get advice without paying directly for it, through brokers' opinions or sales literature, and, in general, they should not expect better than average results from that. Be wary of any one broker or salesman promising spectacular income or profits, whether by selecting winners or by the elusive art of trading. A standard result, earned steadily and safely, is a good friend. If you are prepared to pay a fee for management, you may sensibly choose a well-established, well-recommended investment counsel firm, or use the investment department of a large trust company, or employ the supervisory service on a fee basis of one of the leading exchange houses. Do not expect anything exceptional. Expect results commensurate with those of a cautious, well-informed investor, and, quite possibly, fewer mistakes than you would make alone. That trade is usually worth the fee. 3 practical steps you can try right away. First, write down your advisor mandate in one clean sentence. I expect standard, conservative results. Protect me from avoidable errors. Keep me in high-grade bonds and leading stocks at reasonable prices. Hand that card to any broker or counselor you engage, and make sure the message has landed. Second, separate sales from judgment. When a new issue or opportunity is brought to you by a selling house, insist on an independent check yours if you are competent, or another advisor's if you are not before you act. Recall how easily individuals get swayed in underwriting cycles, and let history cool your pulse. Third, set your safety rails. Confine dealings to reputable exchange members. Route deliveries and payments through your bank until you have reason for full confidence. And be explicit with your broker that you will not trade on tips or mood. It is amazing how much trouble a plain boundary prevents. But what about you? When someone leans in with a confident tone and a bright promise, do you feel the urge to hand over your judgment, or can you pause, ask for the plain arithmetic, and keep your rules in charge? Come sit close with me for this one, because I want to remove the mystery from a subject that scares off too many good people. Security analysis can sound like sorcery. It isn't. It's a set of plain habits for looking at a business and its securities with calm eyes. On Wall Street, people now often say financial analysis, a broader label that can include portfolio policy and even big-picture economics. I'm content to use whatever name fits, but our focus here is the analyst's core work, examining and evaluating stocks and bonds. Picture a doctor who knows the difference between a full physical and a specific test. Both matter, but today we'll do the test well. What does a good analyst actually do? He studies the past, the present, and the likely future of a security. He describes the business, sums up its results and financial position, lists strengths and weaknesses, weighs possibilities and risks, and estimates future earning power, sometimes under different assumptions, sometimes as a best guess. Then he renders an opinion on a bond or investment grade preferred, whether the issue is safe enough for investment, on a common stock, whether it is attractive to buy. In short, he tries to tell you what you own and why you should keep or buy it. Think of a trusted friend evaluating a family business, how it has performed, what shape it's in, where it could go, and whether the price to become a partner makes sense. To do this work, the analyst uses tools from simple to intricate. He will even adjust figures in the company's official statements, the ones blessed by certified public accountants, because numbers can be technically correct and still misleading. He hunts for items that say more or less than they seem to. If you've ever checked your household budget and realized a one-time expense happens every year, you already grasp the spirit of that scrutiny. For bonds and preferreds, the analyst's job is most straightforward. Develop and apply standards of safety that justify purchase for investment. The primary test is coverage, how many times past average earnings have met total fixed charges. And, for preferreds, the combined burden of bond interest and preferred dividends. He also looks at capital structure, working capital, and asset values. It's the creditor's question: will I be paid on time every time? In family terms, it's like asking whether your current income comfortably covers the mortgage, not only your best year, but on average across tougher ones. Common stocks are trickier. Until recently, analysts rarely applied stock standards as clear as their bond tests. Too often the exercise was a tidy summary of the past, a hazy forecast, especially for the next 12 months, and a conclusion that owed as much to the tape and the charts as to the facts. In the last few years, the craft has shifted much attention to valuing growth stocks, projects that often rest on precise projections far into the future and on fancy mathematics. That is the paradox. The more valuation leans on guesses about the future, and the less it ties to figures demonstrated by past performance, the more exposed it becomes to error. It's exactly when the future is foggiest that people want to use the shiniest instruments. If you've ever planned a vacation based on perfect weather, you know how a small change in the forecast can append an elaborate itinerary. So let me set a frame for you, the lay investor. At a minimum, understand what the analyst is driving at so you can tell sound work from superficial work. You don't need a new language. You need a new habit. Ask what assumptions stand behind the numbers and whether those assumptions respect history. That alone will keep you out of many holes. Most people think this kind of analysis begins and ends with reading annual reports. Interpreting those reports is useful. We wrote a short book on it years ago, but this book emphasizes principles and attitudes, not encyclopedias of detail. Instead of repeating a manual on balance sheets, I want to equip you to face two basic questions and not flinch. First, what are the primary tests of safety for a corporate bond or preferred stock? Second, what are the chief factors that determine the value of a common stock? Answer those with discipline, and you will already be ahead of the crowd. On bonds, one practical caution. Authorities differ on exact coverage standards, and any single rule is, in the end, somewhat arbitrary. Some test the average of several years. Others insist on a minimum in the poorest year. I favor including a poorest year check. The point isn't to worship a ratio, it's to refuse thin margins of safety. It's like buying winter tires rated for more than one mild season. You want proof they grip on ice, not just on dry pavement. Now to stocks. There are two broad approaches you will hear about at every lunch table, predictive and protective. The predictive or qualitative approach emphasizes prospects, management, and other factors that resist neat measurement quality, broadly speaking. The protective or quantitative statistical approach emphasizes what you can count and compare, the relation of price to earnings, assets, and dividends. Above all, it insists on paying a price that sits well below a conservative estimate of present value, so that a margin of safety can absorb unpleasant surprises. In bonds and preferreds, that spirit rules. The quantitative method simply extends it to common stocks. It is a different temperament, less about enthusiasm for the future, more about confidence that the enterprise can get along and that you did not pay too much. In my own practice, I committed to the quantitative way. I wanted ample value for the money in concrete, demonstrable terms. I was unwilling to accept promises of the future as compensation for a lack of value in hand. Many authorities would disagree. They put more weight on intangibles, management, and the human factor than on cold figures. At bottom, choosing the best stocks is controversial. My advice to the defensive investor: let that contest alone. Emphasize diversification more than selection. If anyone could choose the best unerringly, diversification would hurt, not help. But in the real world, following the 4 simple rules we set earlier for defensive stock selection leaves room for modest preference without courting harm. Aim for the middle path between neglect and overemphasis, especially as technology and other forces change business fortunes over time. One last warning, stated warmly, because I've seen it bruise decent people. Be skeptical of anyone who leans on elaborate calculations to price the far future of fast-growing companies. The more the valuation depends on far-off forecasts, the more fragile it becomes. The small errors become big ones in a hurry. If you've ever stretched your household budget by assuming a raise that didn't come, you know how a single, slight miss can spoil many tidy plans. Let me leave you with a kitchen table way to use all this. When you look at a bond or preferred, ask, did past earnings comfortably cover the fixed charges even in lean years, and does the balance sheet look sturdy? When you look at a stock, ask, am I paying a price that leaves me a margin of safety against what I cannot predict? Treat projections as friendly sketches, not as contracts. And when the sales talk turns to quality, ask for the arithmetic that guards you if the quality fails to show up on schedule. That is what it means to think and act like an intelligent investor. Write 2 checklists on 1 card. On the bond side, past average coverage of interest and, if any, preferred dividends. Capital structure, working capital asset values. On the stock side, price versus earnings, assets, and dividends. Insist on a margin of safety today, not a promise tomorrow. Read the card before any purchase. Adopt one poorest year habit. When you review a company, don't just average good times. Look at how bad the bad year was and whether your safety still holds. It's the difference between admiring a bridge on a sunny day and trusting it in a storm. Keep your heart with protection, not prediction. If you catch yourself paying because of a forecast, stop and restate the case in present tense. What value do I have in hand at this price? If you cannot answer plainly, you are guessing call it by its name and walk away. But what about you? When someone paints a glowing future with smooth equations and perfect curves, do you feel your guard drop, or can you come back to the simple question, what is my margin of safety at today's price? Let me take your hand and start with 2 thoughts that pull against each other. First, don't take a single year's earnings too seriously. Second, if you do look at short-term earnings, Watch for traps in the per-share figures. I know those two notes don't sit easily together, but quarterly and annual numbers shout so loudly in markets that most people can't help hearing them. So you and I must learn how to listen without being misled. A fresh example lay on my desk as I wrote this. Aluminum. Company of America Alcoa reported 1970 earnings to the decimal. The headline number said $5.20 per share for 1970 versus $5.58 for 1969. For the December quarter alone, it showed $1.58 in 1970 against $1.56 in 1969. To the quick reader, that looks like resilience in a rough year. $6.32 annualized for the quarter, and the stock at 62 less than 10 earnings. But a small a beside that first figure said primary earnings before special charges, and the footnotes ran twice as long as the figures. Read them, and you found four earnings numbers for 1970, not one. Primary $5.20. Net income after special charges $4.32. Fully diluted before special charges $5.01. Fully diluted after special charges $4.19. For the fourth quarter, there were two, primary $1.58 and net income after special charges 70 cents. If you took the quarter at 70 cents, the run rate was $2.80, not $6.32, and a price of 62 was about 22 earnings, not 10. Same company, same year, very different pictures. What were those special charges? The footnotes were specific. Management's estimated cost to close the manufactured products division, the same for Alcoa Castings coal plants. Losses from phasing out Alcoa Credit Coal, and $5.3 million tied to completing a curtain wall contract. Are such items extraordinary, fit to be ignored? A business doing roughly $1.5 billion a year will have many pieces. It isn't extraordinary for one or two to fail. If every loss can be swept into specials, published profits mark only the sunny hours. That is not a fair clock. Here's the simple life test I use. When your own household has a costly mistake, say, a project that runs over, you don't call it special and pretend it never happened. You count it and you spread its sting over the next year or two so you don't forget the lesson. Treat corporate specials the same way. Ask what part belongs to real operating results and what part should be amortized across future periods. The period produced stranger footnotes still. One sizable company summarized its special items this way: about a third of income before charge-offs, provision for closing Spalding United Kingdom operations, provision for reorganizational expenses of a division, costs of selling a small baby pants and bib manufacturing company, disposing of part interest in a Spanish car leasing facility, and liquidation of a ski boot operation. When many enterprises clean house into 1 year, you must be doubly cautious with reported per-share figures. If management and auditors will not say plainly how much of the charge truly belongs to the current year and how much should be dripped into the next few, you cannot know the true earnings for that year. So let me put a fence around the yard. The more seriously you take per-share figures, the more carefully you must guard against four common distortions. First, special charges that never reappear in per-share earnings. Second, a reduced income tax burden produced by past losses that the company can carry forward to shelter future profits. Third, dilution from large amounts of convertibles or warrants. Fourth, accounting choices on depreciation, research and development, and inventory valuation that can lift or lower reported profit without changing the underlying business. Think of these as lenses. Some clarify, others color. You want clear glass. A few illustrations will show why the lenses matter. Train Co. reported nearly a 20% gain, $3.29 versus $2.76. But half of that came not from better business, rather from switching back to straight-line depreciation from an accelerated method used the year before. The company still used the accelerated method for taxes, deferring payment on the difference. Same buildings, same machines, different line in the ledger, different per share figure. In your life, that's like looking richer because you chose to depreciate the family car more slowly on your spreadsheet. It doesn't change the car. Or consider the fad of fussing over pennies. When Dow Chemical included a 21-cent item in regular profits for 1969 instead of tagging it extraordinary income, some analysts fretted. The year-over-year gain was either 9% or 4.5%, depending on that choice. But small differences in one year's result rarely tell you much about future average profits or growth, or about a conservative valuation. Don't let the tail of a single line wag the whole dog. By contrast, sometimes a special is truly special. Northwest Industries planned to write off not less than $264 million in 1970, about $35 per share before dilution. Twice its market price, mainly for selling a railroad subsidiary to its employees and writing down a recent purchase. If that went through unchanged, and if tax law held steady, the loss would allow roughly $400 million of future profits within 5 years to escape income tax. How should you measure real earnings, then before or after the taxes the company will not pay? My answer: first estimate earning power as if full taxes applied, then add a fair bonus for the temporary tax exemption. And beware of dilution. Convertibles and warrants in that case would have more than doubled the common if exercised. What about dilution in general? LCOA's footnote gave fully diluted earnings both before and after special charges. That is already a healthier habit than ignoring dilution altogether. But when substantial warrants or convertibles overhang a stock, you should think of them as part of the common stock package. They belong in your picture of what you are truly paying for and what the per-share claim on profits could become. In daily life, picture a pizza you plan to share. If more people are already waiting at the table with a ticket to claim a slice, don't pretend you will eat the whole pie. One last accounting lens: inventory and R&D treatment. Companies can choose between FIFO and LIFO in value in inventories, and between expensing research in the year incurred or amortizing it over time. Both choices shift reported profits without improving the actual bakery. Again, your goal is not to memorize every rule, but to remember the principle. When per-share figures move because of accounting choices rather than business changes, don't kid yourself that value has jumped. Let's circle back to Alcoa for a broader lesson. From 1958 to 1960, to 1,960, 1,970, average earnings rose from $2.08 to $4.95 to 141% in total, about 9.0% compounded. Annually, actually a bit better than Sears Roebuck at 8.7% and well above the DJI's 5.7%. Yet at the start of 1971, Alcoa sold at only 11 the recent 3-year average, while Sears fetched 27 and the DJIA 15 plus times. Why? Wall Street had grown pessimistic about ALCOA's future despite the fine pass. The high price for Alcoa came way back in 1959 to 116, or 45 earnings, while Sears' 1959 adjusted high was 25.5, or 20. After that, even with excellent profit growth, the overestimate baked into ALCOA's 1959 price proved decisive. By 1970, the stock closed at exactly half its 1959 high, while Sears tripled and the DJIA rose nearly 30%. Strong growth does not entitle any company to a permanently exalted multiple. High multipliers have been sustained only when profitability on capital stayed better than average. Apply our earlier 2-part appraisal. If you took a past performance value at 10% of the DJIAT $4 per, ALCOA share with the DJI8 Hetwood 4-tiered stock looked attractive at 57.25. But what if you believe 1971? Earnings might be as low as $2.50. The market could treat that drop as destiny and slash the price. In fact, the stock fell from 70 in May to 36 in December 1971, with book value at 55. Does one poor year redefine a giant as subpar worth less than its tangible assets? I doubt a single year should carry that verdict. The larger point stands. Corporate accounting is often tricky. Analysis can grow complicated. Dependable stock valuations are exceptional. For most investors, it is best to make sure you are getting good value for the price you pay and let it go at that. Before we step away, let me translate these cautions into everyday acts. When you see a special charge, ask what will be left for next year, the way you'd ask how much of a home repair will still need paying later. When you see fully diluted, picture all those future slices at the table before you count your own serving. When you see a big jump driven by a switch in accounting, treat it like moving money from one pocket to another. It isn't a raise. 3 practical steps you can try now. First, write on a card. I will not judge a company by a single year. I will compare primary, net after specials, and fully diluted earnings. And I will read the footnotes before believing the headline. Keep that promise where you place orders. Second, keep a short lenses checklist, specials, tax carry forwards, dilution, depreciation, R&D inventory choices. If any lens is cloudy, slow down. You would not sign a lease with blurry print. Do not buy earnings with blurry terms. Third, anchor bid judgments in multi-year averages. The table that matters most compares 2-3-year spans, not 2 quarters. You will make fewer mistakes if you price a business by what it has delivered across cycles rather than by what one season seems to promise. But what about you? When a company's latest quarter sparkles or sours, do you feel your view swing with it? Or can you pause long enough to ask what the footnotes say and what the last 10 years really show? Let me tell you what I want to do here, friend to friend. I'm going to sit with you and walk through a small, concrete sample of analysis for companies, looked at with the same calm habits we've been building together. I chose them straight off the New York Stock Exchange list. 4 neighbors in the alphabet: ELTRA, born from Electric Autolite and Mergenthaler Linotype; Emerson Electric, maker of electric and electronic products; Emery Air Freight, a domestic forwarder of air freight; and Emhart, once largely bottling machinery, later builders hardware as well. They make an interesting set enough alike to compare, different enough to learn from. We'll put their market prices and operating figures in one frame, line up their key ratios, and then ask how their business performance lines up with the prices people are paying. Finally, I'll give you a conservative investor's judgment on each. Start with one striking fact that jumps off the page. Their price-earnings ratios differ far more than their operations or finances. 2 of them, Eltra and Emhart, were modestly valued at 9.7 and 12 times the average earnings of 1968 to 1970, compared with 15.5 times for the Dow Jones Industrial Average. The other 2, Emerson and Emery, were way up at 33 and 45 on the same basis. That gap has an explanation. The market rewarded the companies that had grown faster in the recent past, especially the air freight forwarder. But don't mistake that for a dismissal of the other 2. Their growth wasn't poor. Let's take the main elements one by one, the way you would check a family budget, line after line, before you decide what you can afford. Profitability first. All 4 earned satisfactory returns on the money shareholders had put in book value. Emerson and Emery stood out with especially high returns, and it's common for a high return on invested capital to travel with a higher growth rate in per-share earnings. Looking at profit as a share of sales, operating income to sales, the picture is again satisfactory across the board, with Emerson especially impressive. Stability next. I measure it by the worst drop in per-share earnings in any one of the past 10 years compared with the prior 3-year average. On that test, the 2 popular names showed 100% stability, no decline. Eltra and Emhart did see earnings contract in the poor year 1970, but only by about 8%, which was not much worse than the Dow's own 7% shrinkage. In plain language, the unpopular pair held up quite decently when times turned rough. Growth. The low multiple pair grew well, both outpacing the Dow, with ELTR US figures especially impressive when you set them beside that modest PE, the high multiple pair. Of course, showed more dramatic growth, but that is already in their higher price tags. Financial position. The three manufacturers carried solid balance sheets with current assets comfortably more than twice current liabilities. Emory's ratio was lower, though its fine record suggested it could raise cash if needed. Long-term debt was relatively low all around. One caution on dilution: Emerson had a sizable block of low-dividend convertible preferred outstanding. For analysis, we treat it as if already converted, which trims recent per-share earnings by about 10 cents, roughly 4%. Dividends. What matters most is continuity. Emhart's record is the best no interruption since 1902. ELTR ACE is very good. Emerson satisfactory. Emory is the newcomer. At current prices, income told the same story the PEs told in reverse. Yields were roughly twice as high on the cheap pair as on the dear pair. Price history. Over the 34 years in view, the Dow's low to high range ran about 11 to 1. Our four companies' long swings were even greater, from 17 to 1 for Emhart up to a remarkable 528 to 1 for Emory Air Freight. That's how enormous the market's long-range opportunities and overreactions can be. In the 1,969-1,970 break, Eltra and Emhart lost more than half their market value. Emerson and Emory fell hard too, but not quite so far, and then bounced to a new all-time high before 1970 ended for Emerson, and in early 1971 for Emory. Now let me step back and speak plainly about each in turn, with the conservative investor in mind. Emerson Electric's total market value at the end of 1970 towered over the other three combined. I would call it a goodwill giant, a company for which the market is paying a very large sum beyond the tangible assets, in expectation of enduring earning power. The comparison that comes to my mind is Zenith Radio, a brilliant growth story for many years, also once valued around $1.7 billion, 1966. Then profits cut in half by 1970 and the stock down to 22.5 from a prior 89. High valuations carry high risks. They demand exceptional performance for many, many years to be fully justified. Emory Air Freight looked the most promising for future growth. If you accept a PE near 40 times its highest reported earnings as even partly reasonable. Past growth was stunning, but it began from very small earnings, $570,000. In 1958, and scale changes the difficulty of compounding. Even more, its profits could prove vulnerable to tougher competition or to changes in arrangements between forwarders and airlines. A conservative investor has to keep those possibilities in the reckoning. Emhart and Eltra tell a quieter story. Emhart's business record outpaced its stock record over roughly 14 years. In 1958, the shares fetched about 22 times current earnings, similar to the Dow then. By 1970, profits had tripled while the Dow was up less than 100%. Yet the stock price closed only a third above its 1958 high, versus 43% for the Dow. Eltra shows a similar pattern. No glamour here, no sex appeal, yet the statistics look surprisingly good. For a second opinion, I often glance at what Standard & Poor's was telling its clients. In 1971, their notes ran along these lines. ELTR's operations were partly cyclical, but supported by an established competitive position and diversification. Emerson, adequately priced on the current outlook, had long-term appeal given acquisitions, industrial strength, and international growth. Emory looked amply priced on near-term prospects, but worth holding for the long pull. Emhart was worth holding, with 1972 earnings, likely helped by better business conditions. Those are sensible, middle-of-the-road judgments, not a bad backdrop for our own. Where does that lead the careful buyer? Here's my heartfelt counsel. Be especially cautious with Emerson. The market has assigned over $1 billion to the intangible earning power factor. And while the electronics field had fallen on hard days generally, Emerson was an outstanding exception. It would have to remain an exception for many years to vindicate its 1970 price. By contrast, at 27 for Eltra and 33 for Emhart, you could regard yourself as buying into solid businesses at cost close to what the balance sheet shows as invested capital companies with long satisfactory returns on that capital, steady profits, and surprisingly good long-term growth. Those two also meet the 7 statistical requirements I set for a defensive investor's list: adequate size, strong financial condition, dividends continued for at least 20 years, no earnings deficit in the past 10 years, per share earnings up at least 1/3 over the decade, price no more than 1.5 times net asset value, and price no more than 15 times the past 3 years' average earnings. I cannot promise the future of Eltra or Emhart. In any sensible list, there will be disappointments. One or both could falter. But a diversified list, chosen by those principles and any other sound criteria you prefer, has shown itself to do well enough across the years. That much long experience will allow me to say one last practical reminder before we turn the page. Even if you accept all this reasoning, I would not have told an owner of Emerson or Emery at the end of 1970 to swap into Eltra or Emhart unless he truly understood the philosophy behind such a move. There was no reason to expect a low multiple pair to outrun the high multiple pair over a short span. The favorites enjoy good standing and momentum, and that can carry on for some time. The real basis for preferring Eltra and Emhart is a settled choice for value-type investments over glamour-type investments. In that sense, your policy depends on your own temperament. We'll explore that more in the next chapter. 3 practical steps you can try right away. Write a tiny comparison card before you buy any favorite PE on a 3-year average, price to book, dividend yield, current ratio, and worst year earnings decline. If the numbers look like Emerson Emery versus Eltra Emhart in 1970 glamour valuations against decent, sturdy figures, ask yourself which side of that trade you're truly choosing. Circle continuity. Favor companies with uninterrupted dividends over long spans and balance sheets that cover the bad year, not just the good ones. Treat a rich long history like a friend who has kept promises for decades. Decide your side value or glamour before the pitch. If you mean to be a value buyer, be content when the market yawns and your names look dull. Do not expect dull to outrun dazzling in a month. That patience is a policy, not a mood. But what about you? When a fast-growing favorite shines and a sturdy wallflower stands nearby at book value, which one does your hand reach for, and which one does your long-term self want you to choose? Let me sit beside you and lay this out as simply as I can. If you're the cautious sort, the kind who wants to sleep well, you will own 2 things: high-grade bonds and a diversified list of leading common stocks that you did not pay too much for. Your job is not to outguess the market. Your job is to make sure the stocks you buy are big enough, strong enough, steady enough, and cheap enough to carry you through rough weather. There are 2 plain ways to build that stock list. One is the cross-section approach. Buy a true slice of the leading issues, taking the good with the merely respectable, the expensive crowd pleasers alongside the quieter, cheaper names. The simplest version is to buy the same amount of all 30 companies in the Dow Jones Industrial Average. Back when the Dow stood around 900, 10 shares of each would have cost roughly $16,000. The other way is more selective. Test each candidate against a few hard standards, so you get a minimum of quality in its record and finances, and a minimum of substance, earnings, and assets for every dollar you pay. That's the road I want to walk with you now. Here are 7 down-to-earth tests. Think of them as guardrails. If a company clears them, it deserves a place on your short list. Adequate size. I want to screen out the frail. Use round, simple cutoffs. For an industrial company, not less than $100 million of annual sales. For a public utility, not less than $50 million of total assets. This is not an insult to small firms. It's a concession to the defensive investor's need for sturdiness. Strong financial condition. For industrials, current assets should be at least twice current liabilities, a 2-to-1 current ratio, and long-term debt should not exceed the net current assets, working capital. For public utilities, total debt should not exceed twice the stock equity at book value. These are sanity checks, not perfection tests. Earning stability. There should be some earnings for the common stock in each of the past 10 years. No blank years. A business should feed its owners through thick and thin. Dividend record. Uninterrupted cash dividends for at least the last 20 years. A long habit of paying owners is one of the best marks of quality there is, earnings growth. Over the past decade, per-share earnings should have risen by at least 1/3. Using 3-year averages at the start and at the end, I am not hunting rockets. I am insisting on progress. Moderate price-earnings ratio. Don't pay more than 15 times the average earnings of the past 3 years. You are not buying dreams. You are buying a share of a business. Price must respect what has been earned, not just what might be earned. Moderate price to assets. Don't pay more than 1.5 times last reported book value. There's one flexibility. A lower earnings multiple can justify a somewhat higher price to book. As a workable rule of thumb, keep the product of PE based on 3-year average, times price to book at 22.5 or less. That's 15 times 1.5. It also admits, for example, 2.5. A few general comments belong here. These tests are meant for your temperament as a defensive investor. They will exclude most stocks in 2 opposite ways, either for weakness in size, finances, or dividend history, or for being priced so richly that there is no margin of safety. Many analysts will tell you it is reasonable to pay generous prices for choice companies. My contrary view is simple. If too large a part of your price depends on perpetual increases in future earnings, your margin of safety has vanished. You must decide that question for yourself, but decide it with your eyes open. We do insist on a modest growth requirement. Without it, too many companies would show drift or backsliding. And if you observe the 5/10 earnings limit, your portfolio's average multiplier might settle near 12 to 13 times. When I wrote this, you could see first-class names American Telephone and Telegraph at about 11 times 3-year earnings, Standard Oil of California at under 10 times the latest year. As a guiding anchor, let your stock list at cost show an overall earnings-price ratio at least as high as the current high-grade bond yield. With AA bonds at 7.5%, that implies a PE no higher than 13.3. What happens if you apply these tests to a leading list? At the end of 1970, every issue in the Dow met them, though a couple only just. Size was ample across the board. Financial condition was adequate in the aggregate, not for every single company. And every constituent had paid some dividends since at least 1940. 5 could trace their dividend records back to the 19th century. That is the kind of continuity a defensive investor can lean on. If you prefer an even simpler way to manage yourself, you can still use the 4 house rules that echo this spirit. Diversify adequately, roughly 10 to 30 issues. Favor large, prominent, conservatively financed companies. Require long records of uninterrupted dividends. And impose maximum prices relative to earnings, no more than 25 times a 7-year average, and no more than 20 times the latest 12 months. These aren't meant to be fashionable. They're meant to keep you honest when the market flatters you into forgetting price. Let me pause and make this personal. If you had to choose between owning a wonderful company at a fancy multiple or a very good company at a moderate multiple and near book value, with a long, unbroken habit of paying its owners, which would let you sleep? My answer, as your friend, is the second. I have seen too many wonderful stories end with the same sentence. The price was too high. The tests above are less about perfection and more about not overpaying for promise. Now, how do you put this to work on your kitchen table? First, decide whether you like the cross-section route, a plain slice of the leading list, or the tested route. If you choose the cross-section, set your lot sizes and be done with it. Do not spend the next year second-guessing the expensive favorites. You bought the basket because you meant to let the leaders, as a group, do your heavy lifting. If you choose the tests, enforce them without apology. When you are tempted to make an exception, remember why you adopted rules in the first place. And give yourself one anchoring habit. Whenever you total your stock holdings, convert the purchase prices into an overall earnings price ratio and compare it to the high-grade bond yield you could earn today. If your EP is lower than the bond yield, you are leaning away from your own margin of safety. If it is roughly equal or higher, you're on sturdier ground. This simple comparison keeps your feet where they belong on arithmetic. Write your 7 tests on a single card and keep it by your checkbook. Size: $100 million sales industrials. 50 meters assets utilities. Strength 2-to-1 current ratio. Long-term debt is less than or equal to working capital. Utilities debt is less than or equal to 2 equity. Earnings: no deficits in 10 years. Dividends paid for 20 plus years. Growth is greater than or equal to 1/3 per share in 10 years. Using 3-year averages, price, PE is less than or equal to 15 on 3-year average. Assets, PB is less than or equal to 1.5, and PE times PB is less than or equal to 22.5. If a candidate fails, you pass. Pick your path and commit. If you prefer the cross-section approach, buy equal amounts of the leading issues and stop fussing. If you prefer the tested approach, fill a list of 10 to 30 names that pass your card and keep the overall EP at least as high as the high-grade bond yield. For example, APE no higher than approximately 13.3 when it gains you 7.5%. Recheck once a year. Confirm that each holding still meets the spirit of your test and that your portfolio's average PE and PB still leave you a margin of safety. Resist tinkering unless quality can be plainly improved or price has strayed far beyond your limits. But what about you? When a beloved company sells at a price that breaks your limits, do you feel the pull to look the other way, or can you hold to your rules and trust the comfort they bring? Let me be honest with you, friend to friend. If you choose the enterprising path, the temptation is to believe that a bit of extra effort must surely buy you better than average results. At first glance, that sounds obvious. To match the Dow Jones Industrial Average, you could simply hold those same 30 stocks. So, with study and care, why not do better? And yet the long record tells a sobering story. Many well-run investment funds, equipped with top analysts and full research departments, with operating costs roughly 0.5% a year, still failed, as a group, to beat the broad averages. In the decade 1951 to 1960, common stocks returned about 15% annually. In 1961 to 1970, roughly 6%, numbers big enough that a small dose of superior skill should have overcome that cost handicap, but generally did not. In one careful study of 1960 to 1968, equal-weighted random portfolios of NYSE stocks outperformed mutual funds in the same risk classes by 3.7% and 2.5% per year for low and medium risk groups, only 0.2% for high risk, reminding us how hard it is to win by selection alone. Does that mean you must give up on selection? Not at all. It means you and I should ground our effort in simple, testable rules that put arithmetic on our side and our emotions in check. Imagine the way you shop for your household. You don't wander the store hoping for magic. You walk in with a list and a budget. We will do the same. Here is one workable way to build that list. Take a sober starting clue, a low price relative to recent earnings. For our illustration, we began by scanning the stock guide for companies selling at a PE of 9 or less at year-end, 1970, and took the first 20 names beginning, as it happens, with Aberdeen MFG Co. at 10 1/4, 9 times $1.25 per share for the 12 months ended September 1970, and ending with American Maize Products at 9 1/2, also 9 times. That first pass simply says cheap on last year's earnings. Now we stiffen the test. Add 5 further criteria akin to those we suggested for defensive investors, but not as strict. Financial condition, current assets at least 1.5 times current liabilities, and total debt no more than 110% of net current assets for industrial companies. 2. Earning stability. No deficit in the last 5 years covered in the guide. 3. Dividend record. At least some current dividend. 4. Earnings growth. Last year's earnings greater than those of 1966. 5. Price versus assets. Price less than 120% of net tangible assets. In our small sample, those 5 filters cut 20 candidates down to 5, widening the search to the first 450 issues. Produce a little portfolio of 15 that met all 6 requirements, low multiple plus the 5 tests above. Scaling the same winnowing across the full guide, roughly 4,500 companies, would likely have yielded about 150 names clearing every hurdle, leaving ample room to apply judgment. Choose, say, 1 out of every 5. To keep the quality sensible, we also glanced at the earnings and dividend rankings based on 8 years of stability and growth. In our illustrative 15, 10 names were ranked B+, average, and 1, American Maze. Earned in a if you wanted to add a 7th, mechanical screening could only issues ranked average or better. You would still be choosing from around 100 acceptable candidates. A group of at least average quality, meeting financial strength tests available at a low multiplier of current earnings and below asset value, ought to hold good promise for satisfactory results. If you prefer even simpler rules, 2. Single criterion routes have worked well across long spans. A. Buying low multiplier stocks among important companies, for example, from the Dow list, and B. Buying a diversified group of stocks priced below their net current asset value, net nets. The first rests on paying modest prices for large, seasoned enterprises. The second rests on paying so little that the current assets, net of all liabilities, already cover your costs, with buildings, machinery, and goodwill thrown in for free. On the low multiplier blue chip idea, a long series of tests made by Drexel and Company from 1937 through 1969 showed the cheap Dow stocks did worse than the average in only 3 one-year instances, about the same in 6, and better in 25. Over longer 5-year slices, low multipliers again led. An initial $10,000 compounded under that rule would have grown to $66,900 by 1962 versus $44,000 for owning all $30,000 and $25,300 for the high multiplier names. One caveat: at the end of 1968 through mid-1971, a snapshot went the other way, proof that no single ratio should be worshipped without other checks. On net nets, let me restate the definition with care. The most readily identified bargain is a common stock selling for less than the company's net working capital alone, after deducting all prior obligations. Historically, surprisingly many such cases have appeared. A 1957 compilation, at a market level by no means low, found about 150, buying 1 share of each of the 85 that appeared in the monthly stock guide, and holding for 2 years produced a 75% gain, versus 50% for S&P's 425 industrials, with no significant losses among the individual issues. Opportunities grew scarce after 1957, then reappeared in the 1,969-1,970 decline. By early 1971, a quick run-through of the guide turned up some 50 or more names near or below net current asset value, even after removing those with a recent loss. A small table of prominent examples at their 1970 lows gives you the flavor. Coal Mills at 13 with net current assets per share of 18. Janssen at 11 with 12. National Presto at 21.5 with 27. Parker Pen at 9.25 with 9.5. West Point Pepperell at 16.25 with 20.5. These snapshots are a reminder of how far quotations can wander from concrete value. What makes these rules livable is the way they tie to ordinary life. A low multiple is like buying a reliable appliance at a sensible price. You are not betting the house on novelty. A net is like finding a shop offered for less than the cash and stock on its shelves. If you can buy a handful of such shops and keep your nerve, time tends to do the rest. And the winnowing method is simply a shopping list. You start with cheap, then rule out the aisles you know lead to trouble-thin finances, no dividend, shrinking earnings, or a price that already outruns tangible worth. Two more thoughts to hold in mind. First, small companies can be acceptable here, provided you buy them carefully and on a group basis. Second, even when your arithmetic is sound, do not expect glamour to yield quickly to value. Sometimes the market's mood must turn before your quiet list looks wise. Your defense is breath-owning enough names and patience. Write your winnowing card. Start with PE is less than or equal to 9 on last year's earnings. Then require current assets is greater than or equal to 1.5 current liabilities. Debt is less than or equal to 110% of net current assets. No deficits in the past 5 years. A current dividend, last year's earnings greater than 1966. And prices less than or equal to 120% of net tangible assets. Build a 10 to 15 stock list that passes them all. Keep 2 simple screens in reserve. When choices run thin, favor A, low multiplier blue chips from the leading list, and or B, a diversified basket of net current asset stocks, never as single bets, always as groups. Track outcomes like a shopkeeper. Every 6 to 12 months, total the group versus a broad index and check whether the thesis still holds. Adequate quality, sturdy finances, low multiples, and, if you use them, net current asset coverage. If not, restock from the same rules, not from headlines. But what about you? When a checklist tells you to prefer the plain, underpriced shelf over the glittering display, does that feel reassuring, or does a part of you still reach for the shiny box? I want to talk to you quietly about securities that dress up as something better than they are. On paper, convertibles and warrants promise the best of 2 worlds. In life, they often deliver the worst of both unless you handle them with care. A convertible can look like a safe bomb with a ticket to join the stock's rise. A warrant can look like a small key that opens a big door. But nothing in finance becomes a free lunch just because someone braided 2 ideas together. If both sides of a deal seem to win, look again. One side is usually paying with something you cannot see at first glance. Let me set the stage. In recent years, convertible bonds and preferreds became a predominant form of senior financing. Stock option warrants multiplied alongside them. More than half of the preferreds listed in the stock guide carried conversion rights, and a major part of corporate bond financing in 1968 to 1970 did too. There were at least 60 warrant series on the American Stock Exchange. Even American Telephone and Telegraph had long-term warrants listed to buy 31,400,000 shares at $52. When a parade forms behind Mother Bell, expect others to fall in line. You've heard the sales pitch. The investor in a convertible gets bond-like protection plus a chance to join any big advance in the common. The issuer raises money at a moderate interest or dividend cost and may retire the senior security later through conversion. Both sides, it is said, fare unusually well. That cannot be true as a rule. The buyer gives up yield or quality or both in exchange for the conversion privilege. The company, for its cheaper money, gives up part of the common shareholder's future. The only honest conclusion is the modest one. A convertible is like any other security. Its form guarantees nothing. All that matters is the specific facts. Where do these issues tend to hurt people? Start with timing. Convertibles are most plentiful late in bull markets. When the market later turns down, the conversion feature loses attraction, and too often, the underlying safety proves thin. That is why groups of convertibles floated in the later stages of booms have yielded unsatisfactory results as a whole. A simple comparison is telling. From December 1967 to December 1970, the average price decline of convertible preferreds was greater than that of common stocks overall, which fell only 5%, and convertible preferreds did worse than older straight preferreds in that period. In a sample of 20 convertible preferreds, only 1 advanced and 14 suffered bad declines. This is not an accident. It is the pattern of supply meeting optimism. There's also a behavioral trap inside convertibles that I've watched bruise careful people. Suppose you buy a 6% bond at 100, convertible at 25, 40 shares per $1,000. The stock goes to 30. Your bond is worth at least 120 and sells at 125. Do you sell and take a gratifying 25%? If you do, the stock often keeps rising and drags the convertible along. You feel you sold too soon. Next time you hold for 150 or 200. It gets to 140. You don't sell. Then the market breaks and the bond slides to 80. Uniform rules like always sell at 25% to 30% cap. Your wins but not your losses when issues are floated late in a bull market with scant underlying protection. The spectacular opportunities in convertibles often prove illusory in practice, with as many big losses as big gains. If you have ever second-guessed a sale, then froze on the next one, you know the feeling. Even the fine cases teach the wrong lesson if you're not careful. Take the long series of American Telephone and Telegraph convertibles. Buyers did well through the years, yet not quite as well as if they had simply bought the stock. To prove the intrinsic merit of convertibles, you would need many instances where the convertible worked out well even though the common disappointed. Those are hard to find. The good results you remember may only be the market lifting most boats. Convertibles also matter to the owners of the common in a second way: dilution. Many were issued in mergers and acquisitions, and VF's use of nearly $100 million of 5% convertibles plus warrants in the Sharon Steel deal was an extreme case, and the arithmetic effect on per-share earnings is frequently undercounted. Pro forma figures to make earnings per share look larger, and prices respond to that growth. But two offsets always present. First, the actual dilution if conversion occurs. Second, the not-so-visible habit of using convertibles and warrants as a kind of legerdemain in fast-expanding conglomerates. The danger is not in one issue. It is in the tendency to create too many claims on the same future. Sometimes, however, you can turn the structure to your advantage. Because dividend relationships flipped after the mid-1950s, you could often switch from a company's common into its convertible preferred and be better off. The Studebaker-Worthington case at the close of 1970 is a clean example. The common sold at $57, the $5 convertible preferred at $87.50. Each preferred share was exchangeable for 1.5 shares of common, then worth $85.50. A small initial disadvantage in price could be made up in less than a year by the $5 dividend versus $1.80 on the 1.5 common shares. After that, the preferred offered a higher ongoing yield and a senior position, all while the conversion privilege guaranteed. It could not sell below the common package. The common holder, by switching, lost nothing essential and gained several real protections. Now, about stock option warrants. Here I will not mince words. As commonly created, they are near fraud, a present menace, and a potential disaster. They manufacture huge dollar values out of thin air, rob the common a part of its preemptive right, and persist only because people misread the package deal. When a company sells units of stock with warrants, it strips away an element of worth that used to be implicit in every share, the first right to buy more at the next offering, and assigns it to a separate certificate. The package often fetches a better price than the stock alone. The owner ends up with less than he thinks. And reported per-share earnings have often been computed without proper allowance for outstanding warrants, overstating the relationship between earnings and the market value of the capitalization. Finance should be cleaner than that. Pair 2, air products and chemicals versus air reduction. These two are as comparable as comparisons get. Same line of work, names nearly twins. Products was newer and in 1969 did less than half the other sales. Yet its equity sold for about 25% more than reductions. Why? Better profitability and a stronger growth record. Wall Street's familiar preference for quality. But quality came dear. Products at 16.5 times latest earnings against 9.1 for reduction. Products well above asset backing. Reduction at only 75% of book. Reduction paid the richer dividend and carried a more comfortable working capital position. By our standards, products was somewhat overbonded. The thoughtful question isn't which business is nicer. It's whether the nicer business is worth the higher price. Your kitchen table answer may differ from a neighbor's, but price must be in the conversation. What happened next? In the 1970 break, products fell 16% versus 24% for reduction. Early 1971 gave the edge to the low multiple issue reduction, up roughly 50% over its 1969 close against 30% for products. Advantage to the cheaper name, at least for that stretch. If you've ever bought a solid winter coat on sale and found it served you just as well as the boutique one, you see the point. Pair 3. American Home Products versus American Hospital Supply. $2 billion goodwill stories in a booming health sector at the end of 1969 faultless stability since 1958 and strong finances for both. Hospital's growth rate to that date had been higher. Home's profitability on sales and capital was considerably better. On price, Home offered more for the money in current earnings and dividends, while low book values in such franchises signal both strength, high returns on capital, and vulnerability. A high price leaves little room if profits falter. In 1970, the market's favorite hospital showed a microscopic earnings decline, dropped to 32 by February 1971, about 30% below its 1969 close, while Home posted an 8% gain and held slightly above its level. Fashion in multiples cuts both ways. Pair 4, H&R Block versus Blue Bell. Blue Bell built a leadership position in a tough, low-glamour trade. Operations back to 1916, dividends since 1923, earnings growth since 1965, and it sold for only about 11 times earnings when the S&P Composite stood near 17. Block's rise was meteoric. By the end of 1969, revenues of $53.6 million and net of $6.3 million. But a price of 55 more than 100 times the last 12 months' earnings and nearly 30 times tangible assets. The market's ecstasy toward a brilliant service model met the arithmetic of what you were buying. Blue Bell doing 4 times the business, earning 2.5 times as much, with 5.5 times the tangible investment, and offering roughly 9 times the dividend yield yet valued at less than 1/3 of Block. That's not a parlor trick. It's a reminder that popularity taxes price. Pair 5. International Flavors and Fragrances versus International Harvester. The little company most people hadn't heard of was valued at the end of 1969 higher in aggregate than a Dow component with 27 times its annual sales and 17 times its stock capital. Magic words: profitability and growth. Flavors posted sensational margins, while Harvester's record disappointed. Even then I wrote, as your friend, that Harvester's showing was too mediocre to be truly attractive merely because it was cheap. Better values were likely elsewhere. The sequel, Harvester's low price cushioned the 1970 blow, down about 10% more. Flavors proved more vulnerable, off about 30%. Then both recovered, but Harvester soon fell back to the mid-20s. Buying simply because something is down isn't a plan. Value must lead the way. Pair 6. McGraw-Edison versus McGraw-Hill. Names alike, businesses very different. On December 31st, 1968, the two sold around the same price per share, but Hill's larger capitalization made its total value roughly double Edison's, even though Edison had about 50% higher sales and 1/4 larger net income. The key ratio told the story. Hill had a multiplier more than twice Edison's. Why? A persistent market enthusiasm for book publishing shares. Trouble was, by 1968, Hill had already shown 2 years of receding profits. Yet the stock still wore a multiplier of 35 and traded at more than 8 times tangible book goodwill near $1 billion. Hope was triumphing over experience. Edison, by contrast, looked reasonably priced for its quality and position. The next stretch punished the enthusiasm. Hill sank to 10 in May 1970, less than one-fifth of its 1968 close, then recovered to 24 by May 1971. Edison fell to 22 and then recovered fully to 41.5. Optimism is not a moat. Pair 7, National General versus National Presto. Here the contrast turns dramatic. Presto's capital structure was the picture of simplicity. 1,478,000 common shares. Market value $58 million. General's structure looked like a machine shop. More than twice the common shares, a convertible preferred, 3 warrant issues that called for a huge amount of common, a towering convertible bond issue just issued in exchange for insurance stock, and more non-convertible debt, $534 million of market capitalization, not counting another convertible issue, and $750 million including it. Yet in that fiscal year, General did less gross business and only 75% of Presto's net. And when I added the market value of the warrants to the common, because warrants are part of the common stock package, General's true common price more than doubled, and the true multiplier on 1968 earnings became 69. Presto's was 6.9 with all its ratios solid. If you've ever paid more for a suitcase full of promises than for a sturdy trunk that actually locks, you know which trip ends better. What followed? General booked a $72 million loss before tax credit in 1969, about $46.4 million after, fell to 16.5 that year and 9 in 1,975% of its 1968 high, then recovered somewhat. Presto increased earnings in both 1969 and 1970, 10 straight years of growth, yet sank to 21.5 in the 1970 debacle, less than 4 times last reported earnings and below net current assets. If an investor could find 10 such issues for diversification, he could be confident of satisfactory results. Imagine buying a basket of groceries for less than the cash in the store's register. That's the feel of such bargains. Pair 8. Whiting versus Wilcox and Gibbs. This one makes you wonder if the market is a rational institution. The company with smaller sales and earnings and only half the tangible assets behind its common sold at about 4 times the aggregate value of the other. The higher valued name was about to report a large loss after special charges and had not paid a dividend in 13 years. The other had a long record of satisfactory earnings, dividends since 1936, and one of the highest dividend yields in the list at that time, yet it was the cheaper. If you've ever compared 2 apartments, one smaller, with peeling paint that somehow rents for more than the larger, well-kept one, you've seen the same puzzle. Step back with me? Across these pairs, you've watched 2 forces collide, the pull of popularity and the gravity of arithmetic. You've also seen how the market can be wildly generous or needlessly harsh in its multipliers. How capital structures and option overhangs change the true picture. How quality may deserve respect but not any price. How cheap must be more than a word, it must be measurable against earnings, assets, stability, and claims. Most of the issues had large declines in 1961 to 1962, and again in 1969-1970. Any sober investor must be prepared for such swings. And the real job of analysis, as I see it, isn't to guess who will amaze the crowd next year, but to find the minority of cases where the price stands well below value enough so that time and patience can do their quiet work. Make yourself a pair card. When you like a popular stock, force it to stand next to a quieter neighbor from the same or a similar field. Write down 4 numbers for each: price earnings, price book, dividend yield, and any dilution overhang, convertibles or warrants. If glamour glows but the card shows thin assets and heavy claims, pause. Separate business quality from price quality. It's fine to admire profitability and growth. It is not fine to pay any multiple for them. When a company shows receding profits yet carries a 35 multiple and trades at over 8 times tangible book, hear the bell. When a sturdy competitor trades near book with a plain record, give it a fair hearing. Look for simple and solid. Favor enterprises with clear finances, conservative balance sheets, and long dividend habits, especially when the multiple is moderate. Be wary of structures crowded with convertibles, warrants, and towering debt. If you must choose the trunk that locks over the suitcase full of coupons. But what about you? When the crowd's favorite flashes a perfect story and its neighbor looks dull but well-built, which one does your hand reach for, and which one will let you breathe easy a few years from now? I'll tell you something I've felt in my bones since 1934. I have urged shareholders tired, distracted people like you and me, to be awake, to ask steady questions, to praise managers who prove themselves, and to insist on plain reasons when results fall short. You are not asking for favors when you do this. You are asking for stewardship. If a company's results are poor in themselves, worse than those of similar firms, and drag the stock price for a long time, then owners are justified in pressing for answers. And yet, after all these years, the mass of shareholders has seldom changed much by acting together. That could make a sensible crusader put down his banner. But something else stepped in: takeovers. When results are poor, prices sink. Low prices attract outsiders who think they can run things better. Many deals get done by agreement. Others go over the heads of those in control. Often, the price offered lines up with what the business would be worth under reasonably competent management, which means the inert shareholder ends up bailed out by someone else's energy. In practice, weak managers are not removed by scattered public owners. They are replaced when an individual or tight group takes control. Knowing that, more boards have woken up to their duty to secure sound top management. You can see it in the rising number of leadership changes. Still, not every unhappy company is rescued. Too often change comes only after years of bad results and after discouraged owners sell at low prices, making it easier for new controllers to take over. I won't belabor this. If you're one of the few who stand up at annual meetings, you already know what to say. For everyone else, here's a simple plea. When fellow owners send you proxy materials aimed at fixing an obviously unsatisfactory situation, read them with care and an open mind. Now let's turn to the question that most stirs feeling between owners and managers: dividends. For years, the typical tug-of-war ran this way. Minority shareholders asked for more liberal cash payouts. Managers argued to retain earnings to strengthen the company, asking owners to give up present income for a better future. Long ago, weak companies were the ones that clung to profits. Most firms paid out something like 60% to 75%, and the market favored those liberal payers. Lately, a shift has taken hold. The new claim is not, "We need the money," but "We can use it for you more profitably if we keep it." Investors, especially where growth records look good, have grown readier to accept low payout or none at all. In some favorites, dividends or their absence hardly seem to sway price. What does that look like in real life? Texas Instruments rose from 5 in 1953 to 256 in 1960, with earnings marching from 43 cents to $3.91 per share, and no dividend of any kind. When cash dividends began in 1962, earnings were down to $2.14, and the price had broken the 49. The lesson isn't that dividends are bad or good. It's that fashion can overpower arithmetic for long stretches. Another extreme, Superior Oil. In 1948, it earned $35.26 per share, paid $3 in dividends, and the high price was $235. In 1953, the dividend was $1 and the high was $660. In 1957, it paid no dividend at all, and the stock sold at $2,000. By 1962, it earned $49.50 and paid $7.50. Price and payout do not dance to a single tune. Even among giants, you can see the split in sentiment. American Telephone and Telegraph, viewed as having good growth prospects, sold at 25 times 1961 earnings, but rumors or moves about its cash dividends still drove the quote. IBM? The market seemed to shrug at its cash dividend. In 1960, the yield at the high was only 0.5% and 1.5% at the close of 1970. Two blue chips. Two very different ways the market weighed the dividend. If there's a pattern, it's this, where growth isn't the main story. A stock is treated as an income issue, and the dividend still dominates valuation. At the other extreme, when a company is seen as a rapid grower, price leans mostly on expected growth over the next decade, and the cash dividend rate falls out of the picture. But most companies live between those poles, and the market's view can swing widely from year to year. There is even a paradox. The slower growers are often pressed to be more liberal with dividends, even though they are generally less prosperous. Here's the standard I urge you to expect calmly and firmly from management. Either pay out a normal share of earnings, say around 2/3, or show clearly that reinvested profits are building per-share earnings at a satisfactory rate. In a recognized growth company, that demonstration is usually possible. In many other cases, a low payout is exactly why the stock sells below fair value, and shareholders have every right to ask questions and, if needed, to complain. Sometimes prudence ties the purse strings. If a company's finances are weak, needing earnings and depreciation to cut debt and shore up working capital, there isn't much to do except criticize the path that led there. But when a relatively unprosperous company says it must hold down dividends to expand, that is illogical on its face. Owners should accept such a policy only after a complete explanation and a convincing defense. The record gives no reason to assume that expansion with shareholders' money under mediocre management and mediocre results will reward the owners. Now, a careful distinction that confuses many: stock dividends versus stock splits. A split simply restates the share structure, 2-for-1, 3-for-1, to move the price to a lower range. It is not tied to specific reinvested earnings. A proper stock dividend, by contrast, is a small issue, typically not more than 5%, that gives owners a tangible representation of earnings reinvested for their account over a relatively short period, say the past 2 years. Approved practice is to value that stock dividend near the declaration date and transfer an equal amount from earned surplus to capital. In total effect, that is like paying out an equivalent cash amount and simultaneously selling owners new shares worth the same sum. But the straight stock dividend has a tax advantage over the cash plus rights combination long used by public utility companies. For practical purposes, the New York Stock Exchange sets 25% as the line. Distributions of 25% or more are treated as splits, with no need to transfer market value from earned surplus to capital. Yes, some companies still muddy the waters by declaring, say, a 10% stock dividend not tied to recent earnings. That only creates confusion. Where do I come down? I favor a clear public policy on cash and stock dividends. Spell out that stock dividends will be paid periodically to capitalize all or a stated portion of earnings kept in the business. Some have followed a policy that covers 100% of reinvested earnings. I know this view bothers academic writers who call stock dividends just pieces of paper. But that doctrine ignores how investors think and live. A periodic 5% stock dividend may change only the form of the owner's stake. 105 shares instead of 100, yet it offers a real, graspable token of what has been put back on the owner's behalf. There is also a practical choice. Utilities often pay liberal cash dividends and then sell stock back to their shareholders through rights. Owners end up in the same place they would be in if they simply received stock dividends instead of cash followed by rights, except they would save the income tax on the cash they never truly kept. Those who need maximum cash can sell the stock dividends, just as they now sell rights. The potential tax saved by substituting stock dividends for the cash plus rights routine is large. And the fairness is plain. Why tax owners a second time on earnings they immediately return to the company? Good companies modernize their plants, their products, their training, their relations with employees. It is time they modernize their dividend policies with the same seriousness. Write the simple dividend test in your notebook. Either pay out about 2/3 of earnings or prove that retained profits are lifting per-share earnings satisfactorily. When a company fails both sides low payout and no clear per-share progress, ask for an explanation. If none comes, reconsider your trust. When a company pleads weakness, distinguish cause from choice. If retention is needed to repair finances, note it and watch management's plan. But if a mediocre business holds down dividends to expand, demand a convincing case before you accept it. Understand what is being handed to you. Learn the difference between splits and true stock dividends. Favor firms that announce a steady policy of capitalizing reinvested earnings by small periodic stock dividends, often around 5%. Judge utilities by whether they could fairly replace cash plus rights with stock dividends. So owners are not taxed on money. They immediately send back. But what about you? When you look at a company you admire, do you quietly accept whatever dividend policy it serves, or do you ask, as an owner should, whether your share of the profits is reaching you now in cash or later in solid, provable gains? Let me put this as plainly and personally as I can, because it sits at the center of everything I've learned. There are 3 words that keep an investor safe when the world tilts margin of safety. I hold on to it the way a sailor holds his lifeline in a storm. It means leaving yourself room for mistakes, for bad luck, for all the things we never see coming but always seem to arrive. When you buy with a margin of safety, you give yourself a cushion between price and value big enough to absorb surprises without breaking your plan. That idea runs through everything we've talked about. You first meet this idea most clearly in bonds and preferreds. Before you call a bond investment grade, you want proof that the business has earned its fixed charges far more than once. Traditionally, a railroad had to show coverage better than 5 times, measured over a period of years. That past surplus over interest is the safety margin you count on to carry you through a leaner future. A second way says the same thing differently. Compare what the whole enterprise is fairly worth to what it owes. If the business is worth 3 times its debt, the bondholders have a thick cushion. Value can shrink a long way before their claim is in danger. The principle is simple. Every extra dollar of earning power or asset value above the fixed charges is a buffer that protects you from the weather. Why do I insist on a cushion from the past rather than set a forecast about the future? Because the function of a margin of safety is to make precise prediction unnecessary. If your margin is large, you don't need to be exactly right about next year. You only need to be reasonably sure that future earnings will not fall far below the past. That lets you spend your energy on the arithmetic you can verify, not on dreams you can't. In real life, it's the same reason you leave early for the airport. If traffic is heavier than usual, your cushion still gets you there on time. Can we carry this idea into common stocks? Yes, but we must be honest about how. In unusual moments, a stock can have a margin of safety as wide as a good bonds. That happens when the entire company sells for less than the amount of debt it could safely support, conditions I last saw in a broad way in the early 1930s. More recently, in the rare case where a strong company's enterprise value was so low that its recent earnings, before taxes, could easily have backed an equivalent bond issue. In those moments, you get the safety of a creditor with the upside of an owner, an ideal combination, though infrequent. Think of it like buying a well-built house for less than the mortgage the bank would happily give you on it. Your downside is buffered. Your upside is still yours. Under normal conditions, the stock investor's margin of safety lies in this. The earning power behind the price you pay is meaningfully higher than what you could get by lending at prevailing bond rates. Years ago, I illustrated it with round numbers. Suppose the stock's earnings yield is about 9%. That's simply the inverse of an 11 PE, while bonds yield 4%. That extra 5 percentage points is your annual cushion. Some of it arrives as cash dividends. The rest is reinvested in the business for your account. Over a decade, that accumulation can amount to roughly half your purchase price, enough, under ordinary conditions, to prevent or soften losses. And if you spread this across a diversified list of 20 or more representative companies, bought at average levels over several years, your odds of a favorable result become very high. You wouldn't plan a family budget on one paycheck from 1 month. You'd average over many months and keep a savings buffer. Do the same with stocks. But conditions change. When the typical earnings yield on stocks presses down toward the bond yield, when that cushion shrinks, there is less safety even in a careful, diversified stock list. You may still choose stocks to avoid the different risk of holding only fixed claims while money loses purchasing power. But be philosophical about it. The old package of big potential gains with small ultimate risk is not always on the shelf. It pays to recognize, not deny, what the arithmetic of the day permits. Let me soothe one common worry and warn about a bigger one. Yes, paying too high a price for a fine business is a real risk. Prices can bake in more perfection than any company can serve. But the worst losses I've watched have not come from overpaying for quality so much as from buying low-quality issues in boom times when every headline is good. In those seasons, thin bonds and preferreds sell near par because the coupon looks a touch higher or the conversion privilege is glittery. Obscure common stocks float at prices far above tangible investment because the last 2 or 3 years looked excellent. Those are fair-weather purchases at fair-weather prices. When the weather turns, they offer no true margin of safety, and the recovery, if it comes, may take longer than your patience. In everyday terms, it's like signing a long lease on a shaky building because the lobby smelled of fresh paint. What about growth stocks? In theory, careful estimates of future earnings could serve as well as a past record in giving you a cushion. If your projection is conservative and still shows abundant coverage, there's your margin. The danger is that popular growth stocks are often priced so high that even a sober projection will not protect you. The margin of safety lives and dies with the price paid. Large at one level, small higher up, gone at a still higher one. When popularity lifts the average price of growth stocks too far, a simple, buy a bunch of them plan can disappoint not because growth is bad, but because the cushion vanished at the cashier. It's like paying tomorrow's best-case salary for today's job offer. There's no room left if hours get cut. By contrast, the idea is most vivid in bargain securities. There, by definition, you have a favorable difference between price and indicated or appraised value. That difference is the margin. You may feel no special excitement about the company's future, and you need none. If the future looks neither distinctly bright nor distinctly bleak, a purchase on a bargain basis can still work out well even if earning power declines moderately. Your safety margin is doing its job, the way a family's emergency fund smooths a stretch of thinner paychecks. Now, let's tie in diversification. It is a natural companion to the margin of safety. A single commitment can still work out badly. A margin only tilts the odds in your favor. It does not make loss impossible. But as you increase the number of holdings with a margin on your side, the aggregate profits grow more certain to exceed the aggregate losses. That's the insurance business at heart. If it helps, picture the arithmetic of roulette. When the payoff is stacked against you, diversifying your bets only assures losses. But if the payoff were tilted slightly in your favor, steadily spreading your bets would turn chance into expectation. In investing, the margin of safety is at favorable tilt. Diversification is how you harness it. This gives us a clean test to separate investment from speculation. The speculator's comfort rests on subjective feelings. The time is right. My skill is superior. My advisor is special. Those claims may soothe, but they are not margins of safety you can demonstrate. The investor's margin, by contrast, rests on simple arithmetic, persuasive reasoning, and a body of experience, coverage of charges over many years, assets well above debts, earnings yields sensibly above bond yields, prices well below indicated value, and a policy of diversification to let the odds assert themselves. But outside that circle, there are unconventional investments suitable for the enterprising investor when, and only when, price creates the cushion. Undervalued secondary stocks at 2/3 or less of indicated value. medium-grade bonds or preferreds at deeply depressed levels, whole classes of issues that the public first overpaid for at par and now, after a collapse, shuns at a tenth of that price, precisely when the true values behind them are still 4 or 5 times the market quote. If the price is low enough to create a substantial margin of safety, if you are informed and experienced, and if you diversify adequately, even a mediocre security can become a sound investment. The alchemy isn't hope. It's arithmetic. I will even push the logic to the edge because it teaches the point. A diversified basket of long dormant warrants, acquired at historically low prices, could on a reasoned view of the chances that a future bull market will lift some of them well above exercise, price constitute an investment operation with a margin of safety. It sounds like a shocker, and it is, but only to show you that the essence of investment is not the label on the instrument. It is the presence of that demonstrable cushion and the discipline to diversify. In your own life, it's like keeping a shelf of humble staples in the pantry because you know sooner or later dinner needs to be simple and sure. A few business-like rules fall naturally out of all this. Don't enter any operation unless a reliable calculation shows it has a fair chance to yield a reasonable profit. Especially avoid ventures where there's little to gain and much to lose. Base your efforts not on optimism but on arithmetic. And when your analysis is sound, when your facts are in order and your judgment has been tested, have the courage to act, regardless of the crowd's mood. You are not right because others agree. You are right because your data and reasoning are. To get satisfactory results is easier than most people think. To get superior results is harder than it looks. Let me end the chapter as I began, as your friend. A true investment must contain a true margin of safety, one you can show in figures, defend with reasoning, and back with experience. If you build that cushion into your choices, and you spread those choices widely enough, you won't need a profit. You will need only patience and the willingness to keep your rules when the world forgets its own. Write your margin of safety check on a single card. Earnings yield versus bond yield. Coverage of fixed charges over many years, price versus indicated value. Diversify widely. If you cannot show the cushion with numbers and history, treat the idea as speculation, not investment. Decide your bargain discipline. For unconventional choices, require price at 2/3 or less of indicated value for stocks or deep discounts for medium-grade bonds, and then diversify ruthlessly across a group. Your safety comes from the cushion and the count. Keep price honest in growth. If you love a growing business, test whether even a conservative projection will cover today's price. If not, your margin has vanished. Admiration is not a substitute for arithmetic. But what about you? When you're tempted by a story or soothed by a chart, can you stop and ask, where? Exactly. Is my cushion, and is it big enough to carry me through a rough season? If these ideas have brought you more clarity about investing, consider owning an official print or ebook edition of The Intelligent Investor. Every licensed copy you purchase is a tangible way to support the author and the publishing team behind the book.